Good morning, everybody. Welcome back to the Market Open. It is Tuesday, October 29th, 7:25 a.m. Eastern Standard Time. And we've got some earnings to break down and discuss, folks. We got SoFi and PayPal that we're going to be talking about over the next 30 minutes. And then we have the SoFi call at 8 a.m., so in about 35 minutes. And we'll listen to the call, and then we'll get into the regular Market Open. Lot to talk about, lot to get into. Before I get into SoFi and PayPal, one thing that I need to bring to everyone's attention, because it is important, is Bitcoin. Bitcoin last night not only hit 70,000, it hit 71,000. And I woke up this morning not knowing what to expect because Bitcoin is Bitcoin. We are still 10 hours later at $71,255. So a nice run on Bitcoin overnight. We'll see how the momentum kind of continues. You got MicroStrategy up 5%, Coinbase up 3%. You got the miners that are up right now in the pre-markets. Bitcoin 71,242 right now. Pretty exciting to see. And so we'll see how that momentum can continue to expand over the next few hours as we get into the proper market open. SoFi. Let's talk about SoFi. So PayPal is down right now. SoFi is up right now. PayPal missed a little bit on their revenue, actually a lot on their... No, it wasn't the revenue. It was their EPS. We'll get to PayPal in a second, but SoFi is acting so fly. I mean, SoFi right now is up. How much are they up? 6%. At one point, they were at 11.97, so they were up 7%. It would not surprise me if we open the market and SoFi blast through $12. It also wouldn't surprise me if they kind of gap down to 1090s, 1080s. I don't think that will happen. Now, historically, that is what has happened with SoFi. A monster quarter, pre-market pump, open, it dumps, and usually that happens when the macro environment hasn't been that good and the shorts feel more excited to cover. The shorts feel more excited to double down. I don't know if the shorts are going to feel excited to double down on these results, because these results, quite frankly, folks, are incredible. I mean, these are incredible results from SoFi. We're going to go through them in a second, but if I'm a short right now, I have to either think that like this is just not real, this macro environment is not real, the growth I'm seeing is not real, or SoFi's cooking the books to justify being short. Because I don't know how else you justify actually being short, given the growth they're putting up. There's probably random nitpicky things you can disagree with and say, well, this is not growing too well, the tech platform is not fully taking off, etc. But the top line growth, along with the gap profitability, I don't think at this level justifies being a short. I just don't think that's the case. And hopefully we will see some of that covering, which would create a little bit more of a squeeze, given there's 180 million shares sold short. And that would be very good for SoFi. Thank you, everybody, for being here. We have a ton of other companies as well. We have Pfizer, McDonald's, Crocs. We got a lot to get into. So first, let's start off with SoFi, get that out of the way, and then we'll keep going to everything else we've got going on. All right, so let's read from the press release. This is what we have for SoFi. $697 million of revenue, net income of $61 million. That is 5 cents of GAAP EPS. The market was expecting $634 million of revenue, so it's a nice beat on revenue by about $50 million. And 4 cents of EPS. So they beat by a cent and they beat revenue by 40 to 50 million. Record adjusted net revenue with growth accelerating to 30%. That's what you want to see. Again, not a lot of banks growing at 30%. Driven by 64% combined growth in financial services and tech platform segments, representing 49% of total adjusted net revenue. 35% growth in members and strong product innovation remains key in terms of the drivers of growth. They have achieved 756,000 new members, which is big. I mean, I think some people expected getting close to 700,000, but 756 is like serious growth in terms of just the overall member flywheel. And then management is raising their fiscal year 2024 guidance, which is something that they tend to do. And that's what we saw going on. 9.3 million people now are using SoFi. Now, SoFi doesn't give monthly active users, and they don't give kind of any metrics on how many people out of those 9.3 million are active, but 9.3 million do have an account. And it looks like they're adding close to 750,000 every single quarter at this point. I think last quarter they got very close to 700,000 as well. So it seems like that may become a norm. All right, so let's read from what Noto said. This quarter was the strongest quarter in our history. Our results reflect how SoFi is consistently achieving durable growth, how our innovation and brand building are attracting more members and clients to our platform than ever before, and how we are delivering strong and improving results. Our financial services and tech platform segments now make up a record 49% of adjusted net revenue, up from 39% a year ago. That's good to see. In the third quarter, these businesses grew revenue by a combined 64% year over year, a testament to our combined execution and deliberate shift towards capital-light, higher ROE, fee-based revenue streams. The tech platform, if I'm not wrong, brought in, or or I might be wrong on the exact number, but I believe it's the tech platform brought in $240 million of revenue, and that was a big beat. And if I'm wrong on that, then it's actually financial services, not tech platform. But one of the two had a much larger contribution, and the contribution profit margins also increased as a result of it. And a lot of people didn't expect that, which is why I think the street is also excited right now in terms of what they're looking at. So again, GAAP net revenue of $697 million, which is up from $537 million in Q3 last time. So last year, October 2023, around the same Halloween time, I think it was exactly Halloween, October 31st, they reported. The stock was at like $740 and they reported $537 million of revenue. Now they are up 30% from that level, which is incredible. New member additions, again, 756,000, up 35% year-over-year, which is incredible. Financial services segment, total products increased by 33% year-over-year to 11.8 million from 8.9 million. And lending products increased 19% year-over-year to 1.9 million products. Technology platform enabled accounts increased by 17% year-over-year to 160 million. So the tech platform is obviously growing the slowest out of financial services and lending. And really, if they can get that sucker to grow, the street's going to give them a much higher multiple because they're already growing at 30% as an overall business. If the tech platform, which is what really creates the multiples in the stock market in terms of expanding PEs, is able to be a higher level of growth, then that's going to be important. So the thing that beat by 240 million, that's actually financial services, not the tech platform. So the tech platform, I believe, brought in 105 million, which again is not contributing the highest to their sort of multi-plank part of the business with lending, financial services, and tech. But financial services did increase 102% year over year to 238 million. So call it 240 million. Which a lot of people were expecting closer to 200 million. So that's a big beat in terms of what we thought for financial services, which is obviously a very, very big thing for the overall flywheel that SoFi is creating. So let's get to the deck itself. Let's go through this really quickly. Just go through a couple slides that I liked, and then we'll keep going from there. Again, new members, 756,000. That's a big deal. They're starting to really ramp up the level of member growth and the acceleration of that growth. Overall products, 13.6 million. This includes all the different types of loans and different offers that people can be upsold or cross-sold into. Galileo accounts up 17% year over year at 160 million. So this is a declining growth from the Q1 to Q2, which was 23%. And it's declined over the past 2 quarters. Again, Galileo is part of the tech platform. The tech platform is just not ramping up to the levels that the other parts of the business are. That's okay. But, and the street's okay with that right now, giving them a 7% lift. But if that does start to really ramp out, I mean, I think that's where SoFi breaks out and it becomes a behemoth in the financial services space. But that part of the business right now is just not growing as much. So again, financial services up 33%, lending products up 19%. Loan originations were awesome, especially for student loans as well. Credit performance was fine. Delinquencies are under control. EBITDA performance is at a 27% margin, which is not bad at all. Again, adjusted net revenue is at 30% growth at 689 million. You just got a lot of numbers that you're looking at where you're like, wait a second, why is the street, or why would the street be upset, right? And we're seeing in the pre-market, the street's not upset. The market, when it opens, we'll see what happens. But as of now, the street kind of is looking at these results and they're like, yeah, this is not something that we should be necessarily too upset about. Diluted EPS, you got 5 cents of EPS. Their Q3 guidance was at 4 cents. So again, that's a beat by about 1 cent. And for fiscal year 2024, they are expecting to have financial services net revenue grow more than 80% versus 2023. $1 to $1.5 billion of tangible book value, total capital ratio at 16% year end, GAAP diluted EPS of 11 to 12 cents, GAAP net income of 204 to 206 million. They got 61 million in net income this quarter, and adjusted revenue of about 2.5 billion with adjusted EBITDA of 645 million. Raising guidance, beating on EPS, revenue, and member growth, and then ultimately showing financial services with a stronger margin than what a lot of people expected. It's one of those quarters where you're like, all right, I think the street's going to be happy about this. And I think the street, I mean, I think given the macro tailwind that we're seeing with rate cuts coming down, which hopefully on November 7th, we get another rate cut. I think $12 is in the books for SoFi. And, I don't want to get too ambitious and say this thing could go to 15 because it's already up from 7. So it's already had a run. And, I don't know what the big catalyst is towards the end of the year outside of just the broader market doing well. But if the broader market does well, I don't think it has to say in the low 11s. Now, one thing I will caution is there is a world in which this thing tanks and it goes back to 1050 or something, which still would be amazing because it's already up from 7, just given the nature of how the shorts kind of manipulate the stock and what happens with it. ultimately, I think my assumption is the shorts will get scared if Noto can really say some good things on this call, and they'll cover. And maybe you don't get a crazy squeeze, but you get a little bit of a squeeze, enough for the stock to breathe a little bit and not have 18% of a short float breathing down its neck. But if that doesn't happen, then we're going to have to see kind of how the stock ultimately plays out and what goes from there. Let's talk about PayPal. So PayPal's having a little bit of the opposite reaction. It's funny because PayPal's down 4% right now. PayPal last night was up 3%. It was up $86 from 83 to 86. So it's up $3 overnight. And it's because they got an upgrade from, I forgot the name of the bank, but the bank said they should be worth like $110 as fair value, which was great. And everyone was excited. And then PayPal at one point was down like 9% this morning. And I saw that right after SoFi. And I was like, okay, this is not the best. But it was because they missed on a couple numbers. Let me get the exact miss for you guys. PayPal missed on revenue. So instead of bringing in 7.89 billion, they brought in 7.84, which again, that's a miss, but is that a big miss? Not really. And then EPS, they street wanted 107, they brought in 120. So they actually beat by 13 cents on EPS. They missed very slightly on revenue. I mean, it wasn't a number where it's like, oh my God, this is like horrible. But the stock's below 80 right now, down 4.39%. So I'm not sure exactly what they said in this press release. Here's what we have right now, but there's something here that the street is a little concerned about. So revenues was 7.8 billion, up 6%. Total payment volume was 422 billion, up 9%. That's how many dollars transacted through the PayPal network. Non-GAAP operating income of 1.5 billion, transaction margins of 3.7 billion. That's up 8%. Non-GAAP EPS of 120. Alex Chris says PayPal delivers strong financial and operating results during a highly productive third quarter. We are making strong progress in our transformation as we bring new innovations to the market, forge important partnerships with leading commerce plays, and drive awareness and engagement through new marketing campaigns. We are raising our full year non-GAAP guidance, and we are pleased with the strength we are seeing across the business. We built a solid foundation this last year that will serve us in the years to come in the future. Again, it's one of those things where, look, the company's raising guidance. They're missing slightly on one metric, beating on the other metric. Again, we talked about this yesterday, but a lot of companies that are missing on earnings, they're missing on revenue, they're beating on EPS, which means they're becoming more efficient inside of the business so that margins can go higher for them to bring more dollars through their net income, which then affects their earnings per share, or they're buying back stock, which also can boost that EPS number. But they're missing slightly on the revenue. When I mean slightly, I mean like this is 7.89 versus 7.847. These are just like analysts' projections that are slightly higher that end up being a miss algorithmically, and then the stock falls off if that's the reason why the stock fell off. And it's not something, in my opinion, to be super, super concerned about if you're a PayPal shareholder or if you're looking at other stocks in the market that are missing slightly on revenue and then falling after they take a miss. Also, PayPal was up a decent amount before earnings. PayPal went from like 60 to 85 before earnings. So there was a big move kind of baked into the stock already. And so earnings have to be phenomenal to not have anything, go down. And when you miss on revenue even slightly, that ends up probably triggering SoFi with some of these algos. So that's what we got right now, or PayPal with some of these algos. So that's what we got right now on PayPal, but overall, nothing too crazy. SoFi here at 11.55, it's up 3.2%. At one point, it was up at 11.97. So street's kind of struggling right now, going back and forth. You definitely got some people taking profits. You got other people buying on this earnings. 9:30 is going to determine kind of where SoFi goes. I wouldn't say SoFi is tanking yet. If it goes back below 11, I would say it's tanking. But right now, I don't think it's tanking. Amid any insight in Opendoor, not a fan of Opendoor. Never really loved the business. I think iBuying is tough. Oh, look at Bitcoin, 71,509. But when rate cuts happen, Opendoor should theoretically do well. $1.80 right now. It was up 6% yesterday. Yeah, I don't know enough about the business to get excited about it. I do think in general, when rate cuts happen, to 3% by the end of next year, Opendoor should benefit just by the nature of how mortgage rates will come down and property prices. Theoretically, there should be more supply, which will, and more demand, which can maybe, create more competition to decrease prices for homes. But I think there's just other opportunities in the market that are also exciting outside of Opendoor. But rate cuts should be a tailwind for them. Will you cover McDonald's earnings? Yeah, so let's talk about all the other earnings. So we had McDonald's on the day. McDonald's is down 2.6%. Their E. coli thing seems to be cleared up based on what they put out yesterday. You can now buy a quarter pounder at McDonald's without stressing too much. So the EPS they had on McDonald's, 323. That was a beat versus 320. And revenue was 6.87 billion. That was a beat versus 6.82 billion. So McDonald's with a double beat. Down 2%, probably something they said in the press release, maybe something around guidance that has the street a little cautious right now, but not bad. I mean, it's good they didn't have a miss given the E. coli thing that happened. So you'd rather have them, do well on the top and the bottom line, even if the stock is down, versus have a miss after the whole E. coli incident broke out. Then you have Crocs. Crocs, 360 on EPS versus 311. That's a beat. 1.062 billion versus 1.05 billion. That is a beat on revenue. Crocs, for those that don't know, it's the I guess you can call them shoes or slippers, whatever you want to call them. Now, Crocs stock, the reason it's down 10% right now, in my opinion, it's the same theme we've seen over the past couple of weeks with some of these other earnings. Crocs was up 47% this year. A beat on the top and the bottom with, I didn't check their guidance yet, but I would imagine decent guidance. It does not justify going down 10%. However, if you're up 50% year to date and you're Crocs, right? Like Crocs is not, the biggest tech company in the world. It's Crocs. You're kind of priced for perfection. And I think a lot of stocks that are falling right now, they're actually creating some decent dip opportunities because they were simply priced for perfection. The street can't justify taking you up 10%. So they'll find any nitpicky reason to take you down 10%. And as a shareholder, if you buy in while the stock's up, 50%, it's going to suck because you're down 10%. But if you bought in before the stock went up 50%, a 10% move can't necessarily make you that upset. Just given that the stocks had a really good year and maybe, it got a little frothy, you could argue, going up 50%. This also reminds me of TMDX. TMDX, they did miss on the top and the bottom line, which is why they, had a tough pre-market or after hours yesterday. They're now down 23%. However, the stock was also up 60% year to date. So now it'll be up 30% year to date. But again, a lot of these stocks that are having good runs, if you miss on anything, the street's just not going to be forgiving around that. And if the street's not forgiving, then yeah, you're going to have some downside momentum. But that's what we got going on. SoFi right here at 11.58. You still got PayPal right below $80. Good morning, Wise. PayPal down. PayPal slightly missed on the revenue. That's why they're down right now. I'm going to try to pull up the deck and see what we can look at on the deck as well. But that is the reason they are down. Any other earnings? We talked about McDonald's. We talked about... Did you guys said the stream crash. Did the stream crash? Hold on. Let me see on my side. No, it's good on my side. It's so weird, dude. YouTube's been weird this whole week. Even on Monday, people were saying the stream was crashing. Yeah, I would just refresh it, try to make it a little bit better. This is a YouTube thing. This is definitely a YouTube thing. This is not hopefully not a StreamYard thing. Okay, Pfizer. We also had Pfizer. Let's take a look at Pfizer, then we'll go deeper into PayPal. Pfizer, PFE, up 1.66%. Okay, so Pfizer at 25 was sitting at decade lows with a 7% dividend. That's why it was exciting for a lot of people. Pfizer earnings, beat and beat. There you go. Beat on EPS. Wow, 106 versus 61 cents. That's a hell of a beat. Revenue, 17 billion versus 14. That is not a bad beat. Evan, what's up? Thank you for being here in the chat. Look at that, 17 billion. Stock's only up 1% on a $3 billion beat. And a almost doubling of EPS. These are pretty good numbers for Pfizer. Goodness, 1.66%, still has a 5.8% divvy. Again, Pfizer not the most exciting company in the world, and they definitely have some issues with the pipelines of their drugs. But this is an earnings I think we got to look at a little bit deeper. That's a hell of a beat. And again, even if you don't own Pfizer, if you're just a general market participant looking at what's happening in the economy, every company that we're seeing is beating pretty aggressively, or they're at least doing a double beat. Now, there's definitely companies that are missing here and there, but it's far and few between. And if they are missing, it's either a really bad miss, and those are an anomaly, or it's a slight miss on one of the metrics, EPS or revenue, and that's not that big of a deal. So in terms of how Q3 earnings is going, it's actually going pretty nicely. And today with Google kind of starts off big tech earnings, and that one is, Google, Microsoft, Amazon, Meta. They're going to really set the tone to see if the market can handle some of the results that are coming out. But if they end up putting decent results out, doesn't have to be amazing, decent results, then you got the banks that are doing well. You got pharmaceuticals that are doing well. You got all these retailers that are doing well. Deckers, people are buying their shoes. Like, you got a broadening economy that is not too bad going into this third quarter. And so that's good to see. DJT is up 19%. That is correct. I think we talked about this yesterday. It seems like the market is definitely pricing in, at least on DJT stock, a Trump victory. And this bad boy's at $56 right now after being up 21% yesterday. I personally wouldn't chase this. It's just, it's hard to chase something that's up like almost 100% in the past week. But It seems like the market is kind of betting on this as their Trump proxy if Trump indeed wins the election. Royal Caribbean had earnings. They are down 2.2%. So Royal Caribbean kind of took down the cruise lines with them. They missed slightly on, they missed slightly as well on their EPS, if I'm not wrong. Let me pull that up. No, they missed on their revenue. Again, another company that missed on their revenue versus their EPS. Literally, it's like 20 companies in the past week that I've seen have the same thing happen to them. So 4.8 billion versus 4.9 billion. Very, very slight miss. And then you have EPS at 520 versus 503, 17-cent EPS, a beat. That's a good beat. So it's not bad. Not bad at all. But the stock's down about 2%. All the cruise lines are down about 2% because they kind of move with each other, and Royal Caribbean missing on revenue was one of the reasons why it's down. So that one is down right now. But outside of that, pretty much every other stock this morning has done pretty well in terms of their earnings. Again, SoFi right here is up about 3.49%. And again, PayPal had a great earnings. I don't know what the street is upset about, but they're down 6% right here. Maybe the stock was just up too much going into earnings, and that's why it's getting sold off. I think it's something deeper than that. We'll try to figure out in a second, but PayPal right here is down about 6%. And then you got Bitcoin at 71,471. So let's look at some of the Bitcoin plans real quick. MicroStrategy is at 269. Just incredible. Just absolutely incredible. 5.37%. By the way, do you guys know Microsoft? My boy Adam sent me this yesterday. I gotta show this to you guys in a little bit. Microsoft is like quoting MicroStrategy as a potential company they want to follow in terms of their Bitcoin strategy. I didn't see this until yesterday. Adam showed me this, and I was like, what? So I'll show that in a second because that was kind of crazy. But you got MicroStrategy here at 269. You got CleanSpark at 1316, not bad. You got BitX, 2x leverage Bitcoin fund at 3484, up 5.8%. You got HOOD at 2836. Robinhood again with that betting market that came out yesterday. Very, very strong product. A lot of people are talking about it, kind of going viral right now. And I bought some contracts yesterday. It was pretty much as simple as like buying a stock. It was a great user experience. So that one as well, kind of opening up the potential for the street to think of their broader prediction market ambitions that they could unveil. You got Google that's up a little bit right now in the pre-markets. Riot is up 3.7%. And then where is Palantir? Palantir is at 44.92. Now, quick note on Palantir. Got to say it because it is what it is. And, I'm just the reporter of the news here. Karp sold another 3.7 million shares yesterday. It's a decent amount of shares. I'm not going to lie. He sold 1.7 million shares 2 days ago, sold 3.7 million yesterday. Now, some of the shares were an exercise to sell, like he was exercising his options, and that's why he was selling to cover some of the taxes. I don't know if 3.7 million shares is what needed to be sold to be able to just exercise the sale for the taxes. So he definitely was taking some profits. I think you got to take that information the way you take it. Not only has been Karp selling, but Zucks is selling, Jensen is selling, Bezos is selling, like the Apple Tim Cook is selling. Like a lot of CEOs are taking this opportunity because they have a lot of financial advisors that are saying, hey, you don't get an opportunity many times where your stock is up this much. Do you remember 2022? Do you remember, 2020, 2018 when these are things that I think the conservative risk mitigation teams of these high net worth individuals are advising them to do, which is very fair. It's very fair. Rich people keep their money by protecting their money, not just holding on forever. The only difference I will say there is that most of them have stakes that are obviously much, much, much orders of magnitude larger than retail investors. And so if you're a retail investor with a 10-year trajectory on Palantir or Amazon or Tesla, then it kind of doesn't matter if Elon's selling or Karp is selling or Bezos is selling because these guys have been there for 20 years and they have a lot more shares than all of us. So I don't know if you want to read too much into it, but it is one piece of news that Karp indeed did sell again. And he, maybe deciding that at 44.97, it is a nice price to take some profits at the end of the day. Does Alex Karp get more stocks from SBC? Yes. So that's the other thing. I have to do some more research into how many shares this guy actually has because I still don't fully understand it. And I just need to take a day to read through it. But he has a lot of stocks and he's getting a lot of options exercised from his previous grants. Now I just need to figure out exactly how many shares he fully has. But him and Teal obviously still own a lot of Palantir at the end of the day. SoFi right here up 3.4%, 1157. You got BitX again up 5.9%, CleanSpark up 5.2%, and Palantir down a little bit in the pre-markets. What's also interesting, last thing on Palantir is that They, Carp sold 3.7 million shares yesterday, and the stock was hovering above 45.15. So another reason I think he's selling is because if the liquidity is this massive for a company, then at some point you take advantage of that liquidity. And that doesn't mean the stock has to fall. I'm not saying the stock has to necessarily go up to $60 on this, but the stock doesn't have to go back down to 30 either if the company's executing against growth. If Q3 has crappy growth, yeah, it's going to be a tough earnings, and we're just going to have to deal with that. If Q3 has good growth, Carp selling is irrelevant because there is trillions of dollars of liquidity that doesn't give a shit about Carp selling. They care about making a return on their capital, and they want to put capital into something that is compounding growth and that is part of a larger story and thematic. And if Palantir lives up to that on Q3 earnings, insider selling really becomes irrelevant. But Q3 earnings is when we're going to see kind of how that plays out and if they can maintain this momentum. Okay, PayPal. Let's talk about PayPal. So here's the third quarter performance. What did they say that got the street upset right here? Because I'm looking at a decent EPS beat. So what did they put out? Total payment volume, 422 billion. Free cash flow, 1.4 billion. Wow, that's up 31% year over year. That's incredible. And then revenue, 7.8 billion. That's up 6%. That's in line with expectations. Active accounts, they have 432 million users. So for everyone saying PayPal's a dinosaur, I mean, that's almost 500 million people using the product. So 1% growth, not growing a ton, but still decent number of users. 223 million out of those 432 million are monthly active accounts, which is not a bad margin. Transactions per average account is 61.4. That's up 9%. Number of payment transactions, 6 billion. And then TPA is 34.5, year over year growth over 5%, which is not too bad. What did they say that got the street upset? Transaction revenues are up. Total revenues are up. Margins are up. Transaction margin, that's up 8%. That remember, this was declining 3 quarters ago, and that's when the stock went to 49. That's now up 8%, which is great. They bought $1.8 billion worth of stock last quarter. That's 123% of their free cash flow, 5.4. They have bought almost $6 billion of stock in the past 12 months. 1.8 billion in the past 90 days. I don't know why the street's upset. I'm not sure why the street's upset here. Share repurchase, still going to buy 6 billion. Free cash flow, 6 billion. They are slightly raising their guidance on GAAP EPS. That's good. And revenue is pretty much staying the same for fiscal year 2024. I don't know, guys. Do you have any reason why the street's upset? Because I don't see why the street's upset on these numbers. It's hard to imagine it being down 7-8% right now. Q4 reducing their profit. Okay, so maybe that's the reason. So fiscal year 2024, they're raising overall EPS guidance, but Q4, it seems like they're lowering the non-GAAP EPS. Oh, yeah, you're right. Yeah, I see it right here. Yeah, GAAP EPS is down a little bit. They could still potentially beat on that, but if it would be like 1 or 2 cents. It wouldn't be that massive. I guess that's the reason why the street's mad. I guess that's the reason. EPS is down in Q4. And that's, I mean, yeah, I guess you could justify down 7% on that, but that's kind of aggressive, bro. Given we all know the stock is a core fair value of 110. I mean, anyone who does a basic DCF on PayPal can come to that conclusion with very conservative growth estimates, like 2% growth types of estimates. You still get to like 110, 115. It's surprising that they're taking them down 7% just based on potentially lowering Q4 EPS. Look, maybe that's an opportunity. I don't know. We'll see how the market opens. This could also be just like a stupid dip and the market swoops in and they're just like, this is dumb, especially because it got upgraded last night and gapped up to 86. So at 9:30, we'll kind of see what happens. They need to offer a dividend. So either they do a dividend or they keep buying back shares. I kind of like that they're buying back 123% of their free cash flow into shares. I don't know. I don't think you need, by the way, the Noto SoFi calls in 6 minutes, folks. So we'll listen to Noto in 6 minutes, but I don't think they need to do a dividend if they're doing these many share purchases, but maybe psychologically the street wants a dividend versus share repurchases, even though I feel like it's kind of the same thing right here. So I don't know. Could they do a dividend and repurchases? Yeah, they kind of could. But as soon as you give a dividend, you're kind of admitting that you're not going to grow as much, which is probably something that Alex Chris, given his ambitions, doesn't want to admit because he thinks they can still be a strong compounding company. But the share purchases still are decent. SoFi right here is going down a little bit. SoFi down about 2%, or not down 2%. It's up 2%, but it was up like 7% at one point. Look, the quarter was good. The quarter was not bad. It was a quarter that obviously, in my opinion, deserves closer to 15, quite frankly. If it's 30% growth. Again, it is still a bank. And if you got a decent part of the street valuing it as a bank, then you're not going to get close to 15 on any of the core banking multiples that you use outside of top line growth, which people don't care about that much because, it's a bank. They're not expected to grow that much. But if you give it a little bit of a different valuation multiple or narrative outside of it being a bank, the growth is there to support it at top line 30%. Now, again, the tech platform is not growing at 30%, which would really accelerate, I think, SoFi's valuation. But still, overall company growing at 30%, it's not easy to find compounders at 30%. And, I think the street hopefully doesn't get too upset about that at the end of the day. PayPal forecasts Q4 revenue below estimates as it focused more on higher margin businesses to boost profitability instead of aggressive expansion. Yeah, it seems like that's the headline. Q4 guidance on the top and the bottom seems to be the reason why the street might be a little upset here. It's just down 7% is a hell of a reason to be upset with what's going on with PayPal. All right, let me bring up the SoFi webcast. In about 5 minutes, we will be listening to Mr. Noto speak and discuss what's going on with SoFi. When is the call starting? In 5 minutes. Call starting in 5 minutes. Okay, so that's what we got going on with SoFi. MicroStrategy again up 5.3%. Bitcoin, I think, is really the story of the day at 71,438. I mean, 70,000 last night was awesome to see, but then cracking through 70,000, and it cracked through it in like 5 minutes, maybe. Like I looked up after seeing 70,000, it was at 71, and it was just chilling there at 71, and it was going sideways from 71.2 to 71.3 to 71.4, and it was kind of like normalizing the 71 range a little bit, which was really nice to see. Let's check how much BlackRock bought yesterday. So yesterday the ETFs bought 315 million for BlackRock, 44 million for Fidelity, 38 million for Bitwise, 60 million for ARK. And then total overall 479 million. Last 4 days of inflows have been 192 million, 188 million, 402 million, and then 479 million. Let me show you guys that MicroStrategy thing before we get into the SoFi call that Adam sent me yesterday, because I was blown away, absolutely blown away when I saw this. So this is what Adam sent me around MicroStrategy. So Microsoft put out a report that shareholders are going to vote on. And here's what they said in the report. They call out MicroStrategy. So they say MicroStrategy, which like Microsoft is a tech company, but unlike Microsoft holds Bitcoin on its balance sheet, has had its stock outperform Microsoft stock this year by 313%, despite doing only a fraction of the business that Microsoft does. Microsoft does 60 billion of revenue quarter. MicroStrategy's actual tech platform does 100 million of revenue quarter. Obviously, it's less than the lowest number you can think of when it comes to a fraction, but it is a fraction of the business that Microsoft does. And they're not alone. The institutional and corporate adoption of Bitcoin is becoming more commonplace. Microsoft's second largest shareholder, BlackRock, offers its clients a Bitcoin ETF. So this is a Bitcoin diversification assessment that is in one of Microsoft's latest report. And essentially, they're asking to shareholders right here at the end, resolved, shareholders request that the board conduct an assessment to determine if diversifying the company's balance sheet by including Bitcoin is in the best long-term interest of shareholders. This is another reason why I think MicroStrategy is pumping, because the net asset value trades at a 3.5x premium to Bitcoin, which is ridiculous, quite frankly. Like, that is pretty freaking insane. But if Microsoft is going to buy Bitcoin, and then if Microsoft doesn't, Apple's going to think of it. Google better think of something, because Google's got to, hedge back against maybe their search business getting hit. You got Meta, Zucks. Zucks is cool. Zucks might say, screw it. Like, I like Bitcoin. There's so many different ways you could see Bitcoin getting institutional adoption easily through the ETF that Microsoft can buy, 10 million shares of if they want to get some exposure. And now they got Bitcoin on the balance sheet. And now you got Michael Saylor, who was just early to the party as the first corporation to put Bitcoin on his balance sheet. And maybe that generates an even higher premium for net asset value, which is a very, very big thing. Microsoft suggested shareholders to vote against it, which means it's not going to happen. Yeah, I mean, look, it is a moonshot on terms of if it happens. But if the shareholders do vote for it, which, I mean, I don't own Microsoft stock, but if I did, I would be like, yes, buy some big. I mean, Microsoft has so much cash. Dude. At the end of the day, Microsoft wastes so much money on stupid shit. Like, if Bitcoin goes to zero, okay, maybe they lose $1 billion. But like, If Bitcoin doesn't go to zero, which I think there's a better than 50% chance in the next 10 years, it's not zero. It's closer to 150, 250,000 versus 70,000. And that's an amazing return. It's a 4 or 5x on $1 billion, which is not bad. So I think there is an argument to kind of justify that. Evan says, what about 2022? MicroStrategy went 70%. Yeah, well, we had a recession. If we have a recession, Bitcoin's going to fall, MicroStrategy is going to fall, all these are going to fall. If we avoid that, then, maybe Bitcoin ends up being a long-term resilient part of a corporate balance sheet that can survive over the next decade. All right, SoFi should be coming out very soon in like 30 seconds. Here we go.
Good morning or good afternoon all. My name is Adam and I will be your conference operator today. At this time, I would like to welcome everyone to the SoFi Technologies Q3 2024 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you'd like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, that would be star followed by 2. Thank you. With that, you may begin your conference.
Thank you and good morning. Welcome to SoFi's third quarter of 2024 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now, I'd like to turn the call over to Anthony.
Good morning. Thanks for joining us today. I'm thrilled to share our results for Q3, which was the strongest quarter in our history. I want to thank our members and clients for continuing to put their trust in SoFi, and to thank our team for their absolute grit delivering another great quarter. Our results reflect far more than just 90 days of work. They show how SoFi is consistently achieving durable growth, how our innovation and brand building are attracting more members and clients to our platform than ever before, and how we are delivering strong and improving returns. I'll touch on these 3 topics before handing it over to Chris, who will share our financial and operating results. First, on SoFi's performance as a durable growth company. Q3 was another record quarter for SoFi. We built on the strong momentum from the first half of 2024, putting us on pace to significantly exceed our 2024 plan and firmly on track toward the 3-year outlook we shared at the end of last year. Here are some highlights. Adjusted net revenue reached a record of $689 million in the quarter, a year-over-year acceleration in growth to 30% versus 22% in Q2. For the first time, financial services makes up more than a third of our total revenue. The segment recorded $238 million of revenue in Q3, up 102% from the prior year. I could not be prouder of how we've scaled this segment over the past 5 years since launching these products through a tumultuous and unpredictable environment to now be a $1 billion annualized revenue business, growing over 100% with strong and improving profitability. And frankly, it's still day one. Our tech platform grew to nearly $103 million in net revenue, up 14% from the prior year. We continue to see a strong pipeline of potential partners that are striving to modernize their platforms. Combined, our non-lending segments grew 64% year over year and drove the company's overall growth of 30%. And now they make up a record 49% of total revenue, up from 39% a year ago, driving an important diversification of our business. We also recorded tremendous growth in key revenue drivers, members, products, as well as revenue per product in the quarter. We added 756,000 new members in Q3. That's up 35% year over year to a total of 9.4 million members. We grew products in the quarter by over 1 million to 13.7 million products. That's up 31% year over year or 37% when excluding digital asset accounts related to our transfer of crypto services in 2023. The financial services segment drove 964,000 of those new products. Importantly, revenue per product was $81, up 52% from a $53 a year ago. We believe there remains substantial upside in both product growth and monetization. Our one-stop shop continues to attract great cross-buying behavior by our members. In fact, 32% of new products were opened by existing SoFi members, and 20% of our new members open a second product in their first 30 days. This is the power of the flywheel we have developed. In our tech platform, we reached over 160 million total accounts. That's up 17% year over year. Overall, we're making incredible progress in our shift towards more fee-based, capital-light, and lower-risk revenue sources. Combined, fee-based revenue made up $174 million, or a quarter of our adjusted net revenue in Q3. This revenue grew by 65% year over year. On an annualized basis, that's nearly $700 million in revenue. This progress was driven by a record quarter in our loan platform business, which totaled $56 million in fee-based revenue and is up more than 5x year over year, as well as strong growth in interchange, which is up 2x year over year. Chris will share more details on these areas in a few moments. On top of all of this work to diversify our revenue base to capital-light, high return on equity, and fee-based revenue, we also grew our lending segment in Q3. We seized on the improving rate environment in the quarter, our improving credit trends, and strong performance across all lending products to achieve a record $6.3 billion in loan volume and $392 million in adjusted net revenue, up 14% year over year. Looking back at the progress we've made over the past several years, it's fair to say that SoFi is battle-tested, given the scale, profitability, and growth we have recorded for the total company in 2024, with our largest and most profitable business lending barely growing. It should now be crystal clear that SoFi can drive sustained growth across the cycle. We've achieved 17 of 19 quarters of record revenue through a recession, a pandemic, a 150 basis point rate drop, damage to our largest and most profitable business, student loan refinance, only to face a 500 basis point increase in rates and the collapse of venerable financial institutions in our neighborhood. The innovations we have driven to scale our non-lending revenue, which are capital light and high ROE, have enabled us to grow our total revenue by more than 20% year over year for 17 consecutive quarters, as well as grow both our members and products by 35% or more year over year, excluding digital asset accounts transferred in 2023. Our performance in the hard times is what gives me the strong confidence in our future. Today, we face fewer headwinds than any point in our history. We're heading into 2025 with the most favorable conditions of the last 7 years, with declining rates and a stable economy. With the most diverse business we've ever had, with more members in our ecosystem and more products that serve their needs than ever before. This brings me to my second topic, the innovation and brand building that drive our durable growth. The market for consumer financial services is massive and historically poorly served. A Mintel report found that just this year, 1 in 5 U.S. adults have been in the market for a new savings account. A similar number are looking for new credit cards. Those markets, not to mention those looking for new investment accounts, new checking accounts, new personal loans, new mortgages, and buy now, pay later, all grew year over year. Meeting all of a person's financial needs in one place with world-class products delivered seamlessly and digitally gives us a massive advantage. This is why you will often hear me say, it's a matter of when, not if, we become a top 10 financial institution. To do so, it's absolutely critical that we build the unaided brand awareness to become a trusted household brand name. The awareness we generate for SoFi is highly effective at getting people to try a product. After becoming a member, they cross-buy into another product, then another. They recommend SoFi to others. This flywheel that we've created drives acquisition costs down over time and reliably generates profits that we can invest in new product innovations to serve even more of our members' needs. Our accomplishments in Q3 demonstrate the power of this virtuous cycle. First, we continue to establish SoFi as a trusted household name. We ended Q3 with our highest average unaided brand awareness of all time, up nearly 40% year over year to 7%. Our highly effective marketing engine continues to reach and engage new audiences. For example, Q3 saw the kickoff of the new NFL season at the award-winning SoFi Stadium. We unveiled a new brand campaign with LA Chargers quarterback Justin Herbert, inspiring people to reach their most important financial ambitions. We also launched new partnerships with Los Angeles Sparks forward Cameron Brink and tennis champion Venus Williams. And coming in January, the TGL presented by SoFi, a new tech-infused arena golf league with an exciting match play format across teams of top PGA Tour golfers like Tiger Woods, Rory McIlroy, Wyndham Clark, Xander Schauffele, and Justin Thomas, just to name a few. Second, we continue to innovate so people find unique value when they use our products, starting with our financial services segment. In SoFi Invest, we've seen strong engagement driven by new alternative assets, mutual funds, and money market funds we've rolled out over the past year. Overall, we're providing Main Street investors access to unique investment products historically reserved for the ultra-wealthy, like interval funds, private credit, private real estate, and private venture. We also launched our new directed share program, which offers a modern and streamlined approach to equity programs for companies looking to raise capital through IPOs. And we are expanding our award-winning robo offering later this year. Importantly, we are building the Invest business cost-effectively by appealing to existing members. 70% of signups are existing SoFi members. In SoFi Money, we reached record highs in accounts, total deposits, and direct deposit members. We grew member deposits by nearly $2.4 billion, and annualized debit spend reached $10.3 billion in Q3. We will soon improve our self-serve wire transfers, which, similar to introducing Zelle, will further expand members' money movement options. In our member team, we're beta testing a new Cash Coach product that will analyze members' cash across all of their financial products at SoFi and beyond, and offer various ways to optimize their cash. Whether it's paying down expensive debt, setting up an emergency savings fund, getting more yield on their savings, or making investments in a diversified portfolio that is appropriate for their goals. We're also on track to launch improvements to SoFi Plus, our premium membership tier, and are beta testing a new fee-based subscription option in the coming months. Over time, SoFi Plus will increasingly show the magic of our strategy, deliver incremental and unmatched value across our portfolio of products. In credit cards, we officially launched the Everyday Cash Rewards and the Essential Credit Cards, enabling SoFi to serve more people's spending and borrowing needs, whether it's helping them earn rewards or building their credit. In our loan platform business, what started as a decline monetization funnel has now evolved into an integrated loan platform experience, which now offers just-in-time lending. In Q3, the loan platform business grew 5x year over year, mainly driven by record personal loan volume. We expect this business to continue to grow as we shift towards even more fee-based, capital-light, and lower-risk sources of revenue. We also signed our first 2 direct insurance carriers for SoFi Protect, complementing our comprehensive financial services offering we've built over the last 5 years. Turning to our lending segment. In personal loans, our innovation has helped generate a record $4.9 billion in volume, up 26% year over year, including $1 billion originated on behalf of third parties for our loan platform business. In home loans, we grew total home loan volume 38% year over year to $490 million. Home equity loan volume was up 44% from the prior quarter as rates began to decline. Home purchase and refinancing volumes grew 23% from the prior year period. In fact, home refinancing volume was the highest we've seen since the second quarter of 2022. And finally, in our tech platform, we signed several new partnerships, including processing deals with 2 chartered banks in Mexico and a deployment of Galileo's Cyberbank Core for SoFi's new commercial payment services sponsored bank program. We launched additional fraud prevention solutions, the Galileo Instant Verification Engine, which we call GIVE, as well as Transaction Risk G-Score, both of which help clients enhance their security and operational efficiency. Our new secured credit with dynamic funding offering promotes greater financial inclusion and enables clients to help their customers build stronger credit. And lastly, we launched programs with clients signed in prior quarters, spanning cross-border payments, global payouts, financial literacy, and scalable payment solutions. On top of this relentless focus on innovation and brand building, we built our business to deliver strong and reliable returns well into the future. We achieved record profitability in Q3. GAAP net income reached nearly $61 million, a $327 million improvement year over year, or $80 million when excluding the goodwill impairment expense we incurred in the prior year. EBITDA grew 90% from the prior year to a record of $186 million. All three of our operating segments achieved record contribution profit in the quarter. We continue to improve credit performance in Q3 and are firmly within the life of loan guidance we've previously provided. As we've shared in our last call, delinquencies peaked in March of 2024. Since then, we've continued to see improvements quarter over quarter. Cumulative fair value adjustments, along with delinquencies on an absolute and percentage basis, all performed better in Q3. With all the innovations we've made across marketing, originations, and servicing, buyers continue to see compelling opportunities in SoFi's loan portfolio. Loan sales reached almost $1.3 billion in total this quarter and nearly $5 billion in the last 12 months. And finally, with our strong balance sheet, we are well capitalized heading into an improving rate environment. Our total capital ratio is 16.3%, well above regulatory minimums. In Q3, tangible book value increased $236 million to a total of $4.4 billion. We look forward to building on this momentum and delivering continued returns heading into the new year. In closing, I couldn't be more proud of what we've accomplished, not just for Q3, but for delivering a steady and consistent record of durable growth, incredible brand building and product innovation that help our members and clients, and strong improving returns for our shareholders. The future is bright, and I am fired up for what's in store. With that, I'll hand it over to Chris.
Thanks, Anthony. I'm going to walk through key financial highlights and our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the third quarter of 2024 versus the third quarter of 2023. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. The record results we achieved across all three segments this quarter are a testament of our continued execution, our durable growth in members, products, and clients, and our diversification toward capital-light, fee-based revenue with increased returns. For the quarter, we delivered record adjusted net revenue of $689 million, with growth accelerating to 30% year over year, up from 22% last quarter. Adjusted EBITDA was $186 million at a 27% margin. This represents nearly 9 points of year-over-year margin improvement, demonstrating significant operating leverage across all of our functions, with expense margins decreasing year over year. Importantly, sales and marketing continues to decline as a percentage of adjusted net revenue, decreasing by 4 points year over year. We delivered our fourth consecutive quarter of GAAP profitability, with GAAP net income reaching nearly $61 million, a $327 million improvement year over year, or $80 million when excluding the goodwill impairment expense we incurred in the prior year period. We generated GAAP EPS at 5 cents per share in the quarter. On a trailing 12-month basis, we delivered $214 million of GAAP net income, and when looking at the sum of our reported EPS over the past 4 quarters, we generated about 11 cents per share. Now on to the segment-level performance, where we saw record revenue and contribution profit across all 3 operating segments. Starting with financial services, we achieved $238 million in net revenue, up more than 2x year over year. We reached nearly 11.8 million products in the quarter, up 33% year over year, or 40% when excluding crypto accounts. We continue to improve monetization across all products, with annualized revenue per product of $81, up 52% year over year versus $53 in the prior year quarter. This growth was driven by higher deposits and member spending in SoFi Money and significant expansion of our loan platform business, which I'll describe in a moment. Both of these businesses achieved all-time records for revenue in Q3. We also benefited from new monetizable features in SoFi Invest and saw robust growth in credit card spend. We see significant opportunity for growth in these businesses, as well as SMB and Protect, which are all under-monetized today. Net interest income of $154 million increased 66% year-over-year, which was primarily driven by growth in consumer deposits. Non-interest income grew 235% to $84 million in the quarter, which represents nearly $340 million in annualized revenue. The key driver of non-interest income growth this quarter was our loan platform business, where we refer pre-qualified borrowers to origination partners and originate loans on behalf of third parties. Here's how our loan platform business works. With our best-in-class product, highly effective marketing engine, and network of respected buyers like Fortress, with whom we announced a $2 billion loan platform business agreement earlier this month, we can efficiently match the demand of members shopping for loans with the demand for high-quality loans in the capital markets. When a member takes out a loan, they gain all of the benefits of becoming a SoFi member, along with easy access to other products in our one-stop shop, even though we originated the loan on someone else's behalf. This enables SoFi to serve more potential members while also further diversifying toward less capital-intensive and more fee-based sources of revenue. In Q3, we generated $56 million in loan platform fees, driven by $1 billion of personal loans originated on behalf of third parties, as well as referrals. We also generated $5.5 million in servicing cash flows, which is recorded in our lending segment. Our loan platform business in total added $61 million to our adjusted net revenue. In addition to our loan platform revenue, we continue to see healthy growth in interchange, up 211% year-over-year, as a result of $12 billion in total annualized spend in the quarter across money and credit card. Overall, contribution profit for our financial services segment in the quarter was a record at nearly $100 million at a 42% margin, even as we continue to invest in innovation, acquisition costs that require a payback period, and new opportunities to rapidly grow this operating segment with attractive returns. Shifting to our tech platform segment, where we delivered record net revenue of nearly $103 million in the quarter, up 14% year-over-year and 7% sequentially. Revenue growth was driven by strong contribution from new clients, as well as growth in Latin America, consumer brands in the U.S., and clients with innovative use cases like earned wage access and money movement. Galileo accounts grew 17% year-over-year to $160 million. The segment delivered a record contribution profit of $33 million, representing a 32% margin. We've discussed before how the pipeline spans banks, brands, and fintechs across consumer and B2B, which offer larger and more durable revenue. The pipeline is in a stronger spot than it's ever been, and the investments made in this segment have greatly expanded the market opportunity. Recent wins and pipeline strength are early, but telling signs that the strategy is working. Moving on to lending, we achieved record adjusted net revenue of $392 million, with a record of $239 million of contribution profit at a 61% adjusted margin. These results were driven by 19% year-over-year growth in net interest income, while adjusted non-interest income decreased by 2% year-over-year. Growth in net interest income was driven by a 35% year-over-year increase in average interest earning assets, slightly offset by a 44 basis point year-over-year decrease in average yields. This resulted in an average net interest margin of 5.6% for the quarter. In terms of non-interest income, Q3 originations grew 23% year-over-year to over $6.3 billion and were driven by a record quarter in personal loan originations, which grew 26% year-over-year and 17% sequentially to $4.9 billion, with $1 billion originated on behalf of third parties for our loan platform business. Our student loans business saw origination volume grow 3% year-over-year and 28% sequentially to $944 million, our best quarter since Q1 2022. Home loans volume grew by 38% year-over-year and 17% sequentially to $490 million, our best quarter since 2021. In the third quarter, we sold portions of our personal loan, home loan, and senior secured loan portfolios totaling $1.3 billion. In terms of personal loan sales, we closed approximately $375 million of loans in whole loan form at an execution of 105.9%. These had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have if we held the loans. Our $504 million of home loan sales were sold at a blended execution of 102.6%. Additionally, we sold $81 million of late-stage delinquent personal loans in the quarter. As we've noted in the past, we typically have not sold delinquent loans until such a time that they are charged off. However, we have been able to generate positive incremental value over time in these sales relative to selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. Finally, we sold $312 million of senior secured loans at a par execution. In addition, one of our large senior secured loans with $594 million of principal outstanding was prepaid and refinanced by the borrower and is no longer on the balance sheet. Net, inclusive of new issuance in period, our secured loan balance decreased by more than $750 million sequentially. These transactions demonstrate clear market support for the marks on these loans, with $312 million of our senior secured loans sold at our marked value and another $594 million of senior secured loans prepaid so the borrower could refinance with another bank at more attractive rates. Turning to the profile of our borrower and the overall credit performance. Our personal loan borrower's weighted average income is $164,000 with a weighted average FICO score of 746. Our student loan borrower's weighted average income is $135,000 with a weighted average FICO score of 765. After seeing credit trends peak in Q1, we have seen continued improvement in personal loans. Our on-balance sheet 90-day personal loan delinquency rate was 57 basis points in the quarter, a decrease from 64 basis points in Q2, which is further evidence of surpassing a peak in Q1. Our personal loan annualized charge-off rate decreased to 3.52% from 3.84% in Q2, including the impact of asset sales, new originations, and the delinquency sale in the quarter. Had we not sold these late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 5.0% versus 5.4% last quarter. For our student loans, our on-balance sheet 90-day delinquency rate remained flat quarter over quarter at 12 basis points, while our annualized charge-off rate was 69 basis points. The data continues to support our 7 to 8% maximum life of loan loss assumptions for personal loans in line with our underwriting tolerance. Similar to last quarter, we've provided a loan vintage analysis on page 10 of our investor presentation. Since this only provides a partial window into our loan portfolio, we're unlikely to provide this same analysis longer term. However, it's a helpful illustration of how recent vintages are collectively performing against our 2017 vintage, as this is the last time that we approached 8% life of loan losses at 7.85%. You can see significant improvement in cumulative net losses at a given percentage of remaining unpaid principal for more recent 2022 and 2023 vintages. Specifically looking at the Q4 2022 to Q4 2023 vintages, soon after we made material cuts to credit, net cumulative losses of 3.3% are well below the 4.8% observed in the 2017 vintage at the same point of 49% remaining principal balance. The gap between the newer cohort curve and the 2017 cohort curve widened slightly quarter over quarter. Furthermore, looking at page 11 in the investor presentation, you will notice that only 43% of unpaid principal balance remains from our Q1 2020 through Q2 2024 originations. Among the 57% of principal that has already been paid down, we've seen 6% in net cumulative losses. For life of loan losses on this entire cohort of loans to reach 8% net cumulative losses, the remaining unpaid principal would need to charge off at a rate of more than 10%. Past vintages have performed meaningfully better after this point in the seasoning curve, further improving our confidence in achieving loss rates below 8%. Now turning to our fair value marks and key assumptions. Our personal loans are marked at a 105.7%, 142 basis points higher quarter over quarter. This was driven by a 97 basis point decrease in the discount rate to 4.78%, which was directly driven by the drop in benchmark rates by 113 basis points and offset by 16 basis points of spread widening. The constant default rate, or CDR, also decreased by 28 basis points, which is consistent with the observed credit trends I just highlighted. For our student loan portfolio, the fair value mark increased by 183 basis points to 105.4%. This was driven by a 45 basis point decrease in the discount rate to 3.99% due to an 87 basis point decrease in rates, but offset by 42 basis points of spread widening. The weighted average coupon on the portfolio also increased by 17 basis points. The fair value gains in the quarter were significantly more than offset by our hedge losses and the negative impact from spreads widening. Net-net, we did not see a positive impact on the reported revenue from the change in marks, net of hedge losses and new originations. Switching to our balance sheet, where we remain very well capitalized. Assets grew by $1.7 billion as a result of nearly $1.4 billion growth in loans and approximately $226 million of an increase in cash, cash equivalents, and investment securities. On the liability side, member deposits grew by nearly $2.4 billion to nearly $23 billion, while overall deposits increased to $24 billion. We reduced our brokered deposits by $445 million as we continue to use our consumer deposits to replace higher cost parts of the funding stack. Currently, there's a 220 basis points difference between the interest we pay on deposits and the interest we pay on warehouse lines, which translates to more than $500 million in annualized interest expense savings, given the size of our deposit base. We exited the quarter with just $1.3 billion of warehouse debt drawn. This difference continues to support our net interest margin of 5.6%, underscoring the benefits of having the option of holding loans on balance sheet when advantageous in collecting net interest income. We continue to expect to maintain a healthy net interest margin above 5% for the foreseeable future and benefit from the continued mix shift towards deposit funding, along with our ability to sustain healthy deposit versus lending betas. In terms of our regulatory capital ratios, our total capital ratio of 16.3% remains comfortably above the regulatory minimum of 10.5%. Lastly, we grew book value to $6.1 billion and tangible book value by $236 million sequentially to $4.4 billion, with tangible book value per share at $4. Now on to guidance. For the full year 2024, we now expect to deliver adjusted net revenue of $2.535 to $2.550 billion, which is $85 million higher than our prior guidance range of $2.425 to $2.465 billion. This implies 22 to 23% annual growth versus 17 to 19% previously. This guidance assumes lending revenue will be at least 100% of 2023 levels, financial services will grow more than 80% year over year, and tech platform will grow low to upper teens % year over year. We now expect to deliver adjusted EBITDA of $640 to $645 million, above our prior guidance of $605 to $615 million. This represents a 25% adjusted EBITDA margin. We now expect full-year GAAP net income of $204 to $206 million, above prior guidance of $175 to $185 million, and GAAP EPS of 11 to 12 cents per share, above prior guidance of 9 to 10 cents per share. We now expect growth in tangible book value of approximately $1 to $1.05 billion and continue to expect to end the year with a total capital ratio at or above 16%. In terms of member growth, we expect to add at least 2.3 million new members in 2024, which represents 30% growth. Overall, we couldn't be more proud of our Q3 results. We continue to demonstrate our position as a durable growth story, which is reflected in this quarter's strong results. Despite operating in unpredictable macro conditions, we've maintained a clear focus on executing our strategy, driving returns, and helping our members get their money right. We could not be more excited about the opportunities ahead of us as we continue our journey towards becoming a top financial institution. With that, let's begin the Q&A.
All right, questions. Here we go.
At this time, I would like to remind everyone, in order to ask a question, please press star followed by the number 1 on your telephone keypad. Please keep in mind we'll only take one question per person at a time. Please rejoin the queue for any additional questions. And our first question today comes from Dan Dolev from Mizuho. Dan, please go ahead. Your line is open.
Hey guys, Anthony and Chris, great results as always. Can you give us some more color on the loan platform deals? Like, how do you make money here, and how does this differ from the prior quarters? Thanks again, great results.
Sure. Thanks, Dan. So overall, this is a great fee-based and capital-light revenue source for us. We're not taking balance sheet risk. We're generating meaningful cash fees upfront at time of transfer or referral, and we're able to serve the needs of more members at a more rapid pace than we've been able to do so before. So there are several ways that we make revenue within the business, which has certainly evolved since we started focusing on decline monetization in 2019. First is we send qualified borrowers to platform partners via our Lantern marketplace, and we receive a referral fee if the borrower takes out a loan. The second way we make money is we can embed the specific credit box of our platform partners into our underwriting engine and originate on behalf of those partners, with the transfer of those loans to the partner occurring shortly after origination. For that, we receive an upfront cash fee, and we also retain servicing. The third way, and what's new this quarter, is that we're able to originate on behalf of other third-party investors based on a specific asset characteristic and return profile of that investor, with loans transferred shortly after origination. This is within days or a week. We receive an upfront cash fee, platform fee for that business, and we also retain servicing. And then the fourth way that we can make money, and we've been doing this for a few quarters now, is we can service assets that we do not originate but are held on the balance sheets of other third parties. For that, we receive regular servicing fees that are not capitalized. What I would say is important is in all of these cases, these are assets that we wouldn't have otherwise underwritten unless contracted due to a number of reasons, including first, the credit profile and other characteristics of the assets, which may not be directly consistent with our current portfolio. Second, our own risk appetite may not align with those originations. And then finally, our capital allocation strategy at any given point in time may not align. The last thing I would say here is that there are no financing commitments or loss share agreements associated with any of these deals or partnerships.
And the only other thing I would add, Dan, and this may not be known by a lot of people, but we decline between 70 and 80% of the personal loan applicants to SoFi. And so there's a lot of potential, latent potential there to service them better. And so that's a big number that exists before we even try to do anything else in this business in terms of generating incremental demand or other initiatives to make people aware of the products that we can offer.
The next question comes from Terry Ma from Barclays. Terry, your line is open. Please go ahead.
Hey, thank you. Good morning. So your originations came in ahead of our expectations, and it's increased each quarter of this year. Credit seems to be improving sequentially, and the macro probably a little bit less clear than earlier this year. So I guess going forward, how do you think about originations and lending growth for your own balance sheet versus maybe originating for some of your partnerships?
Yep. What I would say is our overall outlook for originations, or at least growth on the balance sheet, has not changed. We do expect to see modest growth in dollar terms on the balance sheet year over year, and that will continue into Q4. We are happy with the size of the balance sheet that we have today and the amount of net interest income that we're generating. We are seeing excess demand both on the borrower side as well as the loan investor side for our unsecured personal loans, and we've been able to successfully navigate and fulfill that demand through the expansion of our loan platform business. So we would expect not to grow the PL balance sheet meaningfully from where we are today. Where we will migrate into is in a lower rate environment, you would see an uptick in demand for our student loan refinancing business, where we had a really strong quarter this quarter, as well as our home loans business, where we had our best quarter since 2021.
The next question comes from John Hecht from Jefferies. John, your line is open. Please go ahead.
Morning, guys. Congratulations, and thanks for taking my question. I appreciate all the information, on the credit slide about the 17 vintage versus the more recent ones. It looks like, the current vintages are performing better than the 2017 vintage. I'm wondering, how do you guys think about that, the contribution of that performance trend to like return on capital, and how do prepayments or your just payment assumptions impact this outcome as well?
Yeah, thanks, John. So we often talk about underwriting to an 8% life of loan loss target, which obviously reflects the strength of our underwriting and the high quality of our borrower base. However, life of loan losses represents just one of several variables, which in combination actually drive our pricing and underwriting decisions designed to maximize return on equity while adhering to our credit risk tolerance. In terms of how we think about the returns on recent versus some of our past vintages, all-in returns on our more recent vintages are projected to produce meaningfully higher returns. I'm talking greater than 2x versus 2017, with newer vintages expected to produce ROEs above 30%. And I'm defining ROE here as the weighted average coupon minus annual losses, funding costs, and other operational costs, plus origination fees, and then multiplied by the weighted average life and levered. What's really driving those increases in returns is a function of a number of things. First is lower expected life of loan loss rates, as we show in our investor presentation on page 10. Second is the higher pricing beta throughout rate increase cycles. We've demonstrated time and time again that we've been able to maintain really good betas. We were successful in increasing the portfolio weighted average coupon across both products in a rising rate environment over the course of the last few years. And we've also been able to maintain pricing in down rate environments due to the quality of our product. The third way is we've had funding cost efficiencies given our higher reliance on member deposits and success in growing direct deposits and replacing higher cost warehouse funding. And then fourth, we've introduced origination fees over the course of the last year plus, and we're now generating close to $400 million in origination fees annually. So the combination of these drivers is more than offsetting the increase in prepayment speeds and the reduction in weighted average lives that we're observing in some of these newer cohorts. Going forward, what I would say is we're going to be talking about return metrics more often because these life of loan losses don't provide the full view.
And the other thing I would just emphasize, John, and everyone and the shareholders more broadly, is that we've been able to achieve these types of high ROE returns in more recent vintages, despite the fact that rates have been, increased significantly in a very short period of time, and the economy has been somewhat uncertain during that time period. As we look into 2025 and a declining rate environment and a stable economy, we think we can only improve on these returns, and it's one of the reasons why we're leveraging all the different businesses we are across the opportunity set that we have from a return standpoint relative to what we believe is a prudent level of balance sheet risk in a particular asset class such as personal loans. So we think there's a lot of upside and it only gets better from here.
The next question comes from Jeff Adelson from Morgan Stanley. Jeff, your line is open. Please go ahead.
Hey, good morning. Could you just talk a little bit more about the expectations for the loan platform business, how you expect that can grow from here? I know you've said expect that to continue growing, but how meaningful can this become? It seems like, if we look at the numbers today, it's already at a $4 billion run rate. You've got the Fortress relationship, which, correct me if I'm wrong, is additive to that. So that's already $6 billion. And should we be thinking about the economics as close to a 5.5% take rate based on the revenues you reported this quarter? And then I'm just curious, you going to maybe de-emphasize the loan sales a little bit more from here? I mean, it came in a little bit lower at the 375 versus the billion for the last 3 quarters, as you maybe prioritize the loan platform business from here. Thanks.
Yep. So I'll start, and Anthony can chime in wherever. But in terms of the overall growth expectations, what I would say is, as part of that $1 billion of originations that we did, Jeff, in the period, a portion of that did come from the Fortress transaction that we announced earlier in the quarter. So it's not additive to your $4 billion run rate. It's inclusive of that. But we do expect to see continued strong growth in the segment. We have that $2 billion agreement with Fortress, as well as commitments for Q4 and 2025 with several other partners. What I would say is we're one of the very few partners who can deliver assets at scale with the characteristics and return profile that investors are seeking. In terms of de-emphasizing other sales and ABS transactions in favor of this, what I would say is that, demand is as strong as it's ever been before. Like I had mentioned a few questions ago, we're happy with the size of the balance sheet and the modest growth that we're expecting over the course of the next 3 months. But what I would say is that we are seeing excess demand both from borrowers and investors, and a way to fulfill that demand is through the LPB business. In terms of the take rate, what I would say is we're looking at apples and oranges when you're trying to compare this take rate to what you see in the general originate to sell business. These are loans that are originated on behalf of others, and they would not have been originated unless contracted to, given the credit care and overall asset characteristics of the loans, as well as our own risk appetite and capital allocation strategy. What we're receiving is a platform fee for our underwriting capabilities, our marketing capabilities, and our overall operational capabilities. And that platform fee will vary depending on the partner.
And I think, a couple of points just to emphasize. One is the partners in the loan platform business, many of which are new incremental partners on loans, as opposed to the wholesale loan buyers or ABS buyers that we've typically had. They're not all incremental, but a large percentage of them are, including in the most recent quarter. In addition to that, Chris has mentioned a couple of times, these are loans we wouldn't have otherwise originated. And we only originate when we actually have a contract. So it's not a zero-sum game, it's incremental. And the outlook for is pretty significant as we go into 2025 in excess of what you articulated.
The only other thing I would say in terms of, you had mentioned $375 million of sales done in period. We did over $1 billion across all 3 products in the quarter, and $6 billion over the course of the last 12 months in overall loan sales. Quarter to date in Q4, we've already done close to $1 billion in sales across our products as well. So the demand is certainly there. We will continue to fulfill on both ends. But as Anthony mentioned, being able to originate on behalf of others is purely incremental to us.
The next question comes from Kyle Peterson from Needham & Co. Kyle, your line is open. Please go ahead.
Great. Thanks, guys, and good morning. Nice results. Wanted to ask a question on deposits, some of the trends you guys are seeing there. You guys had really nice growth there, despite, I believe you took down the rate paid on member deposits a bit, as rates have gone down. So just any color on whether you've seen any changes in average balances or customer behavior, or if things have been pretty receptive to some of the changes you guys have made on deposit rates kind of early on in the rate cut cycle.
Yeah, we're really proud of the way the SoFi Money product continues to resonate in the marketplace, despite rates coming down more broadly. We've maintained our market share position. We've maintained our ranking in an APY standpoint. Of course, we do not charge fees. We obviously give a number of other benefits, including the high interest rate, not to mention all the functionality you need in one place. So we've seen continued strong trends in deposits, over $2 billion of member deposit growth in the quarter, In addition to that, the spending levels that we're seeing are on par to better to where they have been historically. And so we're continuing getting positive indicators across the entire business as it relates to SoFi Money. The other thing I would just mention is this is one of the key points of where the flywheel starts. Our direct deposit customers are customers that are more engaged. They have meaningfully higher number of products per customer compared to the overall average that we report. And when you look at it on a vintage basis, it's even better than the overall average number of products per direct deposit member. So it's been over a year in which we've operated this business as a bank and been able to control our own destiny and having a competitive advantage in being both an origination platform on loans as well as a national bank that can set its own interest rate and its own value proposition. It's a competitive advantage and one that's continued in the quarter, and we're excited about next year.
The next question comes from Mihir Bhatia from Bank of America. Mihir, your line is open. Please go ahead.
Good morning. Thank you for taking my questions. I wanted to stay with the financial services segment again. And I wanted to just talk about a couple of things there. One is just about monetization in the segment. I think it's up to $81 annually now. Any targets you can share on what you think that can look like maybe this time next year, or just to achieve your 3-year targets that you laid out? Like how much more monetization can that be? And then just related to that, just I guess what is the next growth there? You mentioned SMB and Protect in your remarks. You also launched the credit card more broadly. So maybe talk to us about where that next growth vector is materializing from. I guess really what I'm asking is what's the next lending platform business in that sector, right? Like I think it was a pretty big surprise for a lot of people how much that business grew this quarter. So give us
you've hit the nail on the head, and thank you. You've hit the nail on the head. It's an exciting part of our business. The fact that we're approaching, $1 billion annualized business, very profitable while we're still in investment mode. It's pretty amazing to have a business of that size, $238 million of revenue, growing over 100% and profitable, despite how fast we are growing the number of members and products and revenue per product. And I think the best way to sort of conceptualize where this business could go is to think about those three variables: member growth, product growth, and revenue per product. The revenue per product that we generate today was up meaningfully in the quarter, as you mentioned, but it's nowhere near where it can be long term. As it relates to our invest business, we're monetizing at about half the rate that we think we can monetize it over time. In 2025, we'll take a number of steps where we start to monetize that better, of course, by adding incremental value to the invest experience. Our invest product is unique in that we're trying to be a one-stop shop just within invest. We pioneered fractional shares. We obviously don't charge on trades. In addition to that, we created our own ETFs that would better meet the needs of our new and beginning investors that are lower price point but diversified, allowing our members to do dollar cost averaging in a diversified way. We have award-winning robo accounts, and we continue to evolve those, and you'll see us do more in 2025 behind that to not just grow assets, but also to increase monetization. We do IPOs, which is a direct monetization vehicle, but again, a unique product where Main Street investors get access to IPOs at IPO prices. And then our alternate asset classes and mutual funds that we launched have really been a tailwind for us in terms of driving more engagement. That's something today that we don't monetize that we will monetize in the future. So just in the invest business, we have a over 100% opportunity to increase the monetization per member, not to mention the fact how fast the products and invest are growing. And remember, when you do the calculation on invest product growth, you have to normalize it for the lost crypto members or products that we had a year ago that were transferred. SoFi Money business, we continue to see nice trends in deposits and spending, and the monetization there will continue to improve with more deposits and more spending as opposed to a change in rate per se. In addition to that, our credit card business is another source of monetization opportunity. As balances continue to increase, we'll have more monetization there. In addition, the more members that we add, the more monetization that we drive, because that's a higher interchange revenue than our debit interchange. And so as you see a mix shift, you'll see an improvement in monetization there, not to mention just the absolute increase in monetization. And then as it relates to small, medium business, we're just scratching the surface. The biggest initiative we had so far in 2024 was to take the application process and embed it into the SoFi app. So when all the demand that we get for small, medium business comes to SoFi, they can, within the native app, apply for a loan and then be referred to a partner as it relates to lending. We also do that as it relates to banking. You'll continue to see us do that in a much bigger and broader way. There is monetization there today, but we could do more products and more services to drive greater monetization, not to mention doing it ourselves at some point, which we would like to do over time. It is a early stage business, and we want to crawl before we walk and then ultimately run. So you'll see that in the SMB business. On the insurance side, the deals that we're doing in the marketplace increase our monetization there, but it also increases penetration. So over 100% revenue growth in the quarter, driven by the really strong product growth and revenue per product. And if you just focus on those two measurements, you'll be able to forecast a pretty sizable business with great profitability. The last point I make on profitability is we're still losing a large amount of money in the credit card business and invest business because the payback there is longer. And it's not a business that we get return on in 1 year. It takes anywhere from 1.5 to 2 to 3 years, depending on the J curve of the credit business. So what's masking the profitability is that investment there. If we actually added back the losses that we're losing there, the number would be even bigger on the profitability side. And that's before we've improved any of the monetization.
I found this on the web.
The next question is from Peter Christensen from Citigroup. Peter, your line is open. Please go ahead.
Nice trends here. I was just curious, if bigger picture, can we talk about what you're seeing in the alt credit side? Private credit certainly becoming a theme. Some of your marketplace lending peers have also benefited here. In your discussions, pipeline, just curious if you think this emerging as a larger theme over the next 12, 18 months. And then finally, as it relates to tech platform performance pipeline, can you talk to the degree of decision delay you're seeing currently versus last quarter? Thank you.
Yeah, in terms of the demand for our loans from buyers or investors, similar to other people, the demand has increased quite meaningfully. We are better at being able to meet some of that demand by continuing to evolve our business from origination platform for our own loans and now the evolution of the loan platform business. So similar to others, we're seeing an increase from existing buyers, but also a number of new partners that we've not been able to meet their needs with before, but we now can. So really excited about the declining rate environment, putting a tailwind behind the loans, not to mention our new initiatives there. As it relates to the tech platform, no decisions have been made by any of the big deals that we've been in process with over the last 12 to 18 months. I do think we're coming to the end of some of those decisions being made, and I would just say that we haven't had anything to announce, but I would just tell you I'm confident that we will have some wins there, but none of the decisions have been made on any of the large deals. And I would just give you more color on the types of deals. There are definitely big financial institutions that have to make some decisions on their technology. They continue to really struggle with how they budget for that transition, but without a doubt, there's a technical reason why they have to switch. There's a risk reason why they have to switch, and there's a regulatory reason. And so it's going to be an inevitable change and tailwind to the demand for technology like we have in our tech platform business and specifically in core and processing. And it's just a question of when, and I think we'll win our fair share of deals there, but none have been decided yet. The second area that we haven't talked as much about in the past is the opportunity to help large branded companies that have big installed bases. They're in the financial services business already today through a credit card and a white label credit card. There's absolutely a significant amount of demand from those types of partners for us to do something very similar on the debit side of the business. And we continue to receive RFPs for that type of product. And then, of course, outside of the direct-to-consumer businesses, there's demand from government agencies, there's demand for B2B companies that continue to surface, and some of which we've signed and executed against, some of which will be decided over the coming months.
The next question comes from Jill Shea from UBS. Jill, your line is open. Please go ahead.
Good morning. Thanks for taking the question. You launched the Everyday Cash Rewards and the Essential credit cards while early days. Can you just talk about the early indications there and your view of future growth on the card products?
Yes, we really like the card business long term. It obviously is an expensive endeavor near term. There's a J curve of about 3 years in that business. We have a world-class team that's done this before. That wasn't the case when we first launched. The 2 cards that you mentioned are a direct result of all the work the team, our second team that came in to run this business has done. We did a test with the business. We saw the type of performance that we were hoping to see. Our marketing capabilities there have also helped us deliver the type of performance we wanted to see in those cards, and that's why we went general availability for those cards as opposed to just testing. I will say we will take a very methodical approach to the credit card business. While it is a great ROE business, it also does have the ability to lose a lot of money and lose money every day. And so we'll continue to make sure that that card is something that we market to individuals that we think have a high probability of utilizing it in the right way, and we can get a great return on it. So we'll start with our members, and we'll continue to use the data that we have on them to make decisions. We can use that data to model opportunities off of our platform, which we are starting to do as well. Inside of the financial services business, think about it as a couple of different types of segments. We have businesses that are still growing very fast that are profitable, like SoFi Money. We have businesses that are growing very fast and are losing money, like Invest and Credit Card. And then we have businesses that are early stage, and we're planting seeds that will continue to be harvested over time and grown over time. And this is a business that's in the middle, one that we feel we're confident in terms of our go-to-market, and one that will grow, but we'll do it methodically over time to make sure that we do not push too hard on the investment we have to make and offset the profitability of the overall business. But it'll be a good contributor.
At this time, I would like to turn the call back over to Anthony Noto for closing remarks.
Thank you, operator, and thanks for everyone that's dialed into the call. I have some closing remarks I want to share. As I mentioned at the end of Q2, I could not feel better about what we've achieved and where we're headed right here and right now. The list of achievements is far too great to capture every quarter, so let me be succinct and clear. Despite the tumultuous environment of the past 7 years, we've delivered durable growth, world-class innovation and brand building, and improving returns with 17 quarters of record revenue, consistent 35% plus growth in members and products, 4 quarters of GAAP profitability, and so many other milestones. There is only one reason we've been able to emerge stronger from such a tumultuous environment, and that reason is the people of SoFi, our employees, our members, and our clients. I could not be prouder or more grateful to the people of SoFi. We now face, hopefully, the most advantageous environment that we've seen since I joined the company, and we began the relentless march to be a one-stop shop. Today, we are no longer just a lending company. Today, we are a force to be reckoned with. It is truly our time as we have more products, more members, more capital, and more diverse revenue streams than ever before. We are undeniably the absolute best positioned company to capture the massive opportunities still ahead of us because of the same thing that got us here, our people. Our people are great at heart. Thank you, everyone, for your time today, and we hope you have a great end to 2024.
Goodbye.
This concludes today's conference call.
All right. That is the SoFi call. That is done. I'm sorry for all the yawning, dude. It's already a bit early in the morning. I think I slept at 12. So I woke up at like 6:30. I got some decent sleep, but yeah, dude, the call just tends to be boring. Again, really good quarter for SoFi. If you're just joining, triple B at 697 million, 5 cents of EPS, raised 2024 guidance. The call in the beginning, we had some pep in his step from Noto in his opening remarks. And maybe I want to be kind of objective here. It is, at the end of the day, they're talking about loans and banking stuff, and that's kind of boring objectively. You got to be a real nerd to get into this stuff, which if I had a real big position in SoFi, I probably would be nerdy about it. Like when I had a close to $40,000 position in TFC, I was learning about all this shit, CET ratios, all that. I was like deep into the banking stuff. And then I got out of that and I was like, that stuff's kind of boring at the end of the day. So yeah, I mean, in general, being a bank is a bit boring with the numbers they're discussing, but the energy wasn't in general as big as it could have been. Regardless, the quarter was good, and that's what matters. SoFi right here, just going red as we are 26 minutes away from the market opening. We got as high as $11.99, folks. So the market did get excited about it about 40 minutes ago. And then after the call, I don't think I heard anything on the call to take the stock down, even if the call wasn't the most exciting. The call was whatever. The numbers themselves were good. You are getting a little red right here. Now, remember, SoFi was up 2% yesterday. Overall, 7 to 11 has been a hell of a run over the past 2 weeks, or not 2 weeks, 2 months. And so now it's just a question of when the market opens, kind of how does the street interpret the numbers that we got. On the poll I put in the chat, 62% of you say that after the bell, SoFi will be closer to 12. 38% say closer to 10. SoFi right here at 11.11 right now. Look, a drop all the way back down to like 10.50, I think is possible. It would definitely be historically in line with what SoFi does. However, I don't think that's the worst thing in the world. I mean, SoFi is already up a lot from 7 to 11. And although I do think the macro environment is different and that should create a tailwind, when you're up that much, I mean, same thing with PayPal. PayPal was down, PayPal recovering a little bit right now, but PayPal was down 7%. Not because it was necessarily priced to perfection like some of these other stocks, because PayPal year to date was not up that much, but PayPal did make a big move from like 58 to 86. And when you make that big of a move going into an earnings, sometimes if the results aren't absolutely incredible, which PayPal lowered their Q4 guidance, so there you go. That's where the street can find any reason to sell it off. That's where you can get some downside momentum. PayPal right here down about 2.15%. It was down 7%, so recovering 5% right there. And now SoFi going down 0.5%. So SoFi starting to get into the red. Here's the question to the chat. If you are short SoFi, or if you put yourself in the shoes of a SoFi short, after this call and after these numbers that they put up today, do you continue to stay short? That is the question, because I think that's the existential question right here. I know a lot of people want the squeeze on SoFi. I would love to get a squeeze on SoFi, but you need people to feel that it's worth covering. And if you don't get the covering, then there's no squeeze, right? At that point, you just need more buyers than sellers, but the shorts keep weighing you down. Again, these were the big numbers: 750,000 new members, raised guidance, 5 cents of EPS, 697 million of revenue. Tech platform did not grow as much as financial services. And that, if tech platform grew 30%, as like top line revenue grew 30%, or if tech platform even grew 25%, I think SoFi would be closer to $15 right now, because then you attach a price to earnings on it that is differentiated from bank. And then you really get this kind of AWS of fintech, this multi-layered, financial services fintech company that can do all these different things. But the tech part of the business is not living up to that growth yet. And even on the call, Noto was asked, do you have anything you can tell us about the fintech platform or the Galileo Technisys stuff? And he was like, there's nothing I can disclose right now, but I'm very confident that we will have some big wins. Let me just tell you, that sentence did not make me feel very confident. Him saying, I'm very confident we will have some big wins, is not really making me feel they already have a pipeline set up to get those big wins. And that's just how I'm interpreting it. Right? So I'm interpreting it as the business is lending loans, aka banking. This tech thing is a cherry on top. And hopefully one day, Noto's confidence that they can get some wins actually results in real wins. And until then, it's just a question of how the market interprets the tech side of the business. Okay, some of you guys are saying, yeah, I probably wouldn't cover my short. I agree. If I was short right now, I don't think I would cover. Now, that doesn't mean it's a good short, but I don't know if I have enough faith that the stock runs to 13, 14 and makes me scared to cover. But I also think that could happen. So it's one of those where I wouldn't short it, but if I'm already short, I don't know if I necessarily would be like, oh my God, I gotta cover. Like Palantir's Q2 in August. That's one of those quarters where you gotta cover, right? You gotta get out of it. You're just like, you're scared. This one, I don't know. I don't know if I necessarily feel like that. But again, for those with averages below $8, which I know is a lot of you guys, because the stock was stuck at $7 for a long time. The options average I have is 750. Even if it falls back to 1050, there's still a nice margin of safety there, where the averages can compensate for a decline today. Adam says SoFi calls are boring. That's why they sell off even with the extra pep. And why no one asks why the F don't they have option selling? Yeah, I still don't know why they don't have level 1 options on the platform. It's very weird. But again, the brokerage part of the business is not something they care too much about. They care more about the lending side, but it would be nice if they could add that in as well. So apparently we got some news this morning, folks. Robinhood is getting rid of the 1% deposit match. I just found out about this morning because you guys showed me in the chat, for the unlimited boost. This was actually a surprise to me. I thought that unlimited boost would be around for a while, and it's not. So the email says that they are getting rid of it by November 25th, which means that basically if you put in $100 and you get $1, that's leaving on November 25th. Yeah, here it is. Unlimited deposit boost is ending on November 25th. 2024. So here's my perspective on this. I think two things. I think there's a bullish and bearish aspect to this. The bearish aspect is like, I thought that 1% unlimited deposit boost would last for forever, to be honest. Maybe that's a little naive because it probably wasn't going to last forever, but I did think it was going to last for a long time versus like 8 months. So them getting rid of that is a little, it's annoying because you would want, that 1% deposit boost, I do think is a differentiating reason why people deposit into the platform. However, the bullish part of this is that maybe they have so many deposits that they don't need to give 1%, right? It's like maybe their deposit growth might be growing organically in and of itself, where they don't need to have another expense, which is this 1%, which still is an expense at the end of the day, to be able to fuel deposits if they already have so much deposit growth. And that primarily is on the idea that maybe their transaction revenues are going up because people are trading. They're not keeping their money in cash because the market's going up and the stock and the interest rates are coming down. And as a result, you already have all this organic deposit growth. You don't need to incentivize people to put in deposits if you already have that organic growth. Another argument here is that maybe the expenses were just too much because they had an entire 2 weeks of a 3% IRA match, a 2% brokerage match, and a 1% brokerage transfer match. God knows how much money they brought in over the past 2 weeks from October 16th to October 27th. I personally know a lot of people that have transferred $1 million Roth IRAs. Robinhood was giving them 30 grand to bring that over. So those are a lot of expenses. You would imagine that they're like, all right, we already brought over a shit ton of deposits and we paid a lot of money for these deposits and we don't get to amortize that over 2 years. We have to pay that immediately, whereas the 1% unlimited deposit would be paid out over 2 years. So they're like, hey, we can't really afford to do the 1% unlimited deposit match anymore, but it doesn't matter because the whole point of that deposit match was to get deposits, and we got a lot of deposits, and therefore we don't need to do that. So that's my thoughts on them doing that right there. I don't think it's necessarily bullish or bearish. I think it's more so a question of just adjusting to the unit economics of the business going forward. SoFi now is down 1%. You got SoFi down 1%. We got 20 minutes until the market opens. But SoFi is indeed down 1%. Astrika says, I wonder if they can do it periodically. That's another thing I'm thinking. I think maybe like, Q4 next year, they decide to bring it back. I mean, it's one of those things that you can just flip on and off. And so if they think deposits are going down, they can just flip it on and they say, all right, 1% deposit match is back. Maybe that is one of the strategies they're deploying right here. They've got to be very creative with how they bring in all this money, especially because they're giving these matches. And it seems like, and they're already giving the 3% cash back on the credit card, right? So there's a lot of incentives they're already giving. You would imagine some of those incentives would go away. And it seems like the least important one, which is the 1% deposit boost, is starting to go away. 1092 on SoFi. So now it's down 2.4%. Now we are tanking. I would say this is a tank. Some people are saying 1199 to 1130 was a tank. I was like, that's not a tank. It's just a little drop in the bucket. That's okay. That's all right. 1190 to 1130 is fine. Now 1190 to 1085. Now it's down 3%. Holy crap. It goes down 1% as much. Dude, now it's down 4%. Do I need to stop talking? Like, why is it going down? Every other syllable I utter is like another 0.1%. Holy shit, dude. 1076. Oh my God. SoFi. It is indeed SoFi. Let's go to Hood. Hood is up 1%, 2816. Look, I do think the market's going to be in a precarious situation right now because not only is Bitcoin above 71, we got to kind of see if Bitcoin can maintain that momentum, but market had a good day yesterday. Good day past couple weeks. S&P's already down 0.22%. We got the election coming up in 6 days. I could imagine some pre-election jitters, and that could be another reason why SoFi and PayPal are down, is because market doesn't want to deploy a ton of capital right before the election. So we got to get through that election. We got to get through the rate cuts, and then we can see kind of how to evaluate this. But look, these earnings, I don't think justify being down 2% on PayPal or SoFi. So it is weird that the markets bringing it down right here, right now. Where's Google? They report today. Yeah, so Google's going to be a big one today. We got a lot to look into Google. We talked about them a lot on the market close yesterday. Look, I said I was bullish on Google on Monday. I'm going to continue to keep that mentality. I think they're undervalued and I'm bullish. But if Sundar does not deal with this whole AI is going to take your business question, which has been going around for months, like the fact that Google's down on that question, which unequivocally it's DOJ and Perplexity being a metaphor for AI search engines taking Google's lunch. That has been a question for 7 months, and it looks like investors still aren't confident that Google has an answer to that question, which is very weird. Like if I was Sundar, I would do like a 30-minute podcast with like the biggest podcast host in the world and just like answer this one question for 30 minutes and like be like, hit me with every angle you got. I'm going to answer every single version of how this question plays out. One of the arguments why he hasn't done that potentially is that he doesn't have the best answers, which is fair. It's not really his fault to an extent. It's the idea of Google and these 10 blue links might not be around forever. And Sundar himself is probably trying to figure out how do we navigate this question. But, you know, it's not the best excuse. At the end of the day, you got to get shareholders to be confident. You've got to be able to give them an answer. And I don't know if he has the best answer right now. So look, I think Google's undervalued. I think your earnings are going to be good, even if the growth is going to be lower than what we've seen historically in the past. But it's got to be a response to that question in order to get the stock to move to go a little bit higher. You should interview him. I should definitely. I am interviewing someone today. It'll be posted Thursday night. I think you guys are going to like the interview. 30-minute interview with someone you guys will really enjoy listening to. So if I back above 11, all right, we got some movement here, down 1.4%, but we are back above 11, and that'll be uploaded on Thursday night. I think you guys will enjoy this podcast. But yeah, I think those are my perspectives that we got going on Google. June says, look at the home builders. Where is Lennar, which is one of the home builders? They are down 5%. Why are the home builders down? Hold on. I think we got housing data. Maybe that's why they're down. We do have JOLTS at 10 a.m. Why are the home builders down? Okay, so the house price index came in at 427. The street was expecting 425. House price index month over month was up 0.3%. Street was expecting 0%. House price index year over year was up 4.2%. Street was expecting 4%. So it looks like house prices are increasing heavily. And that is why the home builders are going down. That could be one reason. D.H. Horton had earnings as well. Okay, let's look at their stock. They're another home builder. D.H. Horton. What is their ticker? Oh, DR Horton. Hold on. This one right here, right? DR Horton. They're down 11%. Goodness gracious, bro. Oh my. All right. So this is, Tom Lee last month said we should be looking at the home builders a little bit more. DHI, let me get their numbers real quick. That is a 11% down is a lot. So that along with the mortgage price index increase 4% year over year, 4.7% when the street expected 4%. That's just showing that housing prices are going up, which is not good for the home builders. They want lower prices for houses and they want also more competition, but they need rates to come down for this to happen. So, okay, DR Horton, unsold homes rose 17% quarter over quarter to 10,300, which looks like a cycle high into a seasonally slow selling period. Okay, so that's probably one of the reasons why it's down 11%. They did buy back $561 million of their stock, so about 3.4 million shares. Earnings per share was $3.92. Revenue was $8.9 billion, 23,647 homes they were able to build. CEO says the DR Horton team produced a solid fiscal 2024, highlighted by consolidated pre-tax income of $6.3 billion. Earnings per diluted share in fiscal 2024 increased 4%. Our consolidated cash flow from operations was $2 billion, and we returned all the cash we generated this year to shareholders through dividends and repurchases. What's the divvy on these guys? The divvy is 0.67%, so not a big divvy. Over the past 5 years, we generated $9 billion of cash flow. Despite continued affordability challenges and competitive market conditions, aka rates, our net sale orders in fourth quarter increased slightly from the period prior to 9,035 homes. Our sales pace was in line with normal seasonality from the third to fourth quarter, but was below our expectations. So that's why the stock's down 11%. While mortgage rates have decreased from their highs earlier this year, many potential home buyers expect rates to be lower in 2025. We believe that rate volatility and uncertainty are causing some buyers to stay on the sidelines. In my opinion, that's pretty much all the buyers to stay on the sidelines. To help spur demand and address affordability, we are continuing to use incentives as mortgage rate buy downs as we have continued to start and sell more of our homes with smaller floor plans. So basically, the CEO saying until rates come down, we are not going to have a meaningful change in earnings. And you can see that in the level of homes that they're selling and the miss on expectations against their current sales pace for homes. He further says the supply of both new and existing homes affordable price points is still generally limited, and demographics supporting housing demand are favorable with a focus on affordable product offerings, 37,400 homes in inventory, and continued improvement in our construction cycle times. We are well positioned for fiscal 2025. We expect to generate increasing levels of consolidated operating cash flows, and our liquidity and low leverage provide us with significant financial flexibility. Again, rates got to come down for these guys to get momentum, and for housing prices to go down, and for competition to heat up in the supply of inventory. And without that, you're going to get the home builders that are going to be in a tough position. So Lennar is down 6%. DR Horton is down 12%. The home builder ETF is ticker symbol. What is the ticker symbol? I think it's ITB, if I'm not wrong. ITB is down 4%. Another one is PKB. PKB is down. PKB is flat. And then XHB, let's take a look at that one. XHB is down 3%. All right, so all the home builders are taking a bit of a hit right now as well. Why is SoFi down? That is the philosophical question that none of us have ever been able to answer post earnings. Now you're down 3.4%, back under 11. I don't know. It was a good quarter, guys. It was a really good quarter. The only bad part of the quarter is the tech platform not growing as much, but I feel like at this point, that can't be the defining factor around SoFi. Because if that is, then just take the sucker back to 7 at that point. Like if the street only cares about the tech platform, then like just like send it back down to 7. Like at that point, it's a bank and it doesn't matter. The growth doesn't matter. Nothing matters. If there's something more to the thesis, then I would imagine, it gets a little bit of a boost. I don't know, dude. We got 10 minutes until the market opens. Maybe this reverses when the market opens, but I guess we're going to have to see kind of how this plays out. Missed tech revenues by estimated 3%. If you're not growing as a tech platform, it's not a bank. Frustrating as a SoFi bull. Yeah. I mean, look, top line revenue growth is 30%. This is a company that's growing 30%. It's just not all 30% growths are different. Palantir's 30% growth is different. Robinhood's 40% growth is different, especially when a lot of that money comes down to net income because they have nice tech juicy margins. SoFi doesn't have that as a bank. Those margins are not the same. And so, the street's, I guess, evaluating it differently from a tech platform, even though the growth is up there. Adam says, Amit, as we spoke yesterday, that's why I did such a low cash secured put. SoFi slays and still drops is scary. Yeah, I was on the phone with Adam yesterday, and he has a ton of cash secured puts at 7. And yeah, I mean, it makes sense, kind of aiming low just in case it drops. So my options, these are the options right now that we have on SoFi. We're up 4,700. We put 3,500, so we're up 130%. The perceived opening of this will be up 4,000 instead of 4,700, so they should be down $700 when it opens, unless SoFi reverses. Here's the question to the chat: do I take out my initial? We got a lot of time on these suckers. We got till January 2026. It's a $15, $20 strike. Do we take out the initial 3,500, which means we would sell about half of these and leave the other half and let it ride? That is the safe thing to do. It's like the hedge against SoFi going back to $7 or $8 and like getting hit. I don't think it goes back to that low. I feel like the narrative has changed, which is why I feel like I got the option so cheap. Like the reason I don't want to sell them and take out the initial is because if I got them at the bottom, like if I got the freaking bottom, then I shouldn't need to worry about risk mitigation because it's not going back there. But if it's going back there, then I'm going to feel really stupid if it goes back to $7 and I could have took out the initial. So I don't know, dude. I don't know. I guess we'll have to see how it plays out. I mean, I would love to take out that initial and put it in somewhere else and just not have to worry about it either, right? Because then it's like if SoFi goes to 0, it's like, okay, I don't care. I took out my money. So like if I lose whatever money's in the options, I'm good. I took the rest out. So I don't need to worry too much. Just like from a mental standpoint, it's always nicer to see how that plays out. No SoFi Stadium 2025 Olympics. We're having Olympics in 2025? In the SoFi Stadium? I didn't know that. Okay, that should be a tailwind. I also don't want to be emotional, dude. Just because the stock falls on earnings, I don't want to be like, oh my God, like because like the stock went from 7-11 without any earnings, right? It was just started to break out from a technical level. And we know financials are going to do great in 2025. They're going to do really good if Trump gets elected. Even if he doesn't get elected, financials should have a good year in 2025 with rates coming down. And at that point, SoFi is a financial, right? It should experience a little bit more of that tailwind. DRK says, Amit, great video you did with Gali, great combo. Yeah, thank you guys for watching that. So let me put that in the chat. I know you guys were asking about it. Some of you guys might have already seen it, but Gali from Hyperchange, one of the initial Tesla guys, interviewed me yesterday, and we talked about Robinhood, Airbnb. He has a decent Airbnb thesis, dude. He did say Airbnb could have $80 trillion of profits in the next 12 years, which was a hell of a take. But that just lets you know how bullish he is on Airbnb. But Palantir, Airbnb, Tesla, Robinhood, we talked about all that stuff. So you guys can check it out. Okay, so we've got 6 minutes. Bitcoin is doing its thing, 71,177. MicroStrategy, just insanity at 264, up 3.5%. MicroStrategy now for the year is outperforming NVIDIA, if I'm not wrong. Correct. MicroStrategy is up 272%. NVIDIA is up, I think, 190%. So there you go. You could have bought MSTR and chill. Now, granted, you needed to have the stomach for the volatility, but if you believed in it, the thesis has played out pretty nicely this year. Over the past 1 year, it's up 500%. Over the past month, it's up 50%. Past 6 months, up 97%. Past 5 days, it's up 18%. And today, it's up 3.5% in the pre-markets. Past 5 years, it's up 1,500%. I believe this is the best performing stock, one of like the top 10 ones. NVIDIA's up there past 5 years as well. I think they're at like 2,000% past 5 years. Yeah, NVIDIA's at 2,600%. Tesla, because of 2019, still gets that 5-year bump, up 1,100%. And then MicroStrategy as well, up around 1,100% over the past 5 years, mainly because of Bitcoin. So again, MicroStrategy's core business does $111 million per quarter, but their Bitcoin alpha is a 3.5x net asset value premium compared to the amount of Bitcoin they hold on the balance sheet, which I believe is around 8 billion. And the volatility of it, as Saylor talked about last week in a podcast, is what makes MicroStrategy exciting, which is why you got all this money chasing the stock, especially in the options market. Hood is up because people are pricing in new revenue streams potentially from the take rate of the election contracts. Yeah, so I traded some election contracts yesterday on Robinhood. They take 1 cent per contract. It's a very smooth interface. And look, I don't think they're going to make a ton of money at all. Also, our boy Benjamin Buddish upgraded them to $23. He keeps an equal weight on them. Yes, I understand 23 is a lot lower than what it is right now, but he's never been the most bullish. But he did upgrade them, and he said, look, we don't think that the prediction market election thing is going to give a lot of revenue, but we are excited because we think that could be a bigger market for them overall, which is what I think Vlad's really trying to go after. And if that's the case, then that can become a very exciting story overall for Robinhood. So that's what we had with Robinhood this morning, and Bitcoin going up also helps them as well. Our boy Rishi is also back, folks. So Rishi from RBC has released his latest Palantir price target since August. And the price target includes a sell rating on Palantir, which is no surprise. But one of the things that was a little surprising is that he has maintained his $9 price target. Rishi from RBC has maintained his $9 price target. This is what I call, and I mean this with all due respect, narcissism. It is narcissistic to be so wrong and to feel you are so right, even when the market is telling you that you are so wrong, objectively, given the stock is 5x your price target, that you still hold on to your price target. I think the sign of a good analyst is not how many stock picks they get correct, but how much they're able to adjust when they're wrong on their thesis. And that's just the sign of a good human being, right? If you are wrong, you're able to accept that and move on and navigate from that. You can have a $20 price target. You could have a $25, you could have a $17 price target. A $9 price target is just embarrassing at this point. And I believe it's getting old. In some respects, I do kind of think Rishi's trying to make a name for himself more than really be an analyst, just like Gordon Johnson. We've seen that with Tesla. I mean, Gordon Johnson literally built a career off saying Tesla was overvalued for the past 10 years. And his price target is currently $24, which, again, it's just laughable. But his name pops up, right? So I don't know. Maybe you start seeing Rishi do more podcasts, start his own consulting firm around research, and like get paid off of being bearish, which is a route that a lot of these guys take. Maybe that's what ends up happening. But that is the price target we have right now. Chakoti, thank you for the €249 super chat. Do you think it's worth it to buy Hood at this price? Yes. And look, I'm biased here because I've been buying for a while, but I've been buying a lot as well. When I was in India, I was buying 100 shares every other day, around 26.20 to 27.30. I think the highest I bought was 27.40. So I haven't bought in the 28s yet, but I've been buying because I see a lot of the catalysts coming together. Now, look, my price target now is 30. So if you think 28 to 30 is a good return, then that's fair. But I think if a lot of things come together, 35 is also very possible. So the risk reward is not amazing from 28 to 30 or 20 to 35, but it's not horrible either. So It's one of those things where if you want to establish a long-term position, I think it's just, a constant DCA. If you're buying it on the flip to 30 or 35 bucks, then yeah, it's not the best risk reward. But in the market, there's not that many good risk rewards given everything has run up so much. So it's kind of one of those things where if you want to average up, I've been averaging up. And it seems like I want to hold these shares for the long term, which is why I've been buying more at 26 and 27. I remember when Robin had popped to 25, I was in India, and as soon as I saw the investor day, I bought 50 shares and I tweeted the screenshot, and everyone was like, "Oh my God, you're buying the top. Why are you buying it? It's up 10%." And I was like, no, dude. This is a healthy 10%. Like sometimes you buy into strength, and that announcement of the investor day and how confident they are to present their vision to investors, that to me was a very healthy 10%. And that's why I bought 50 shares that day at 25. All right, here we go. 9:30 a.m. Tuesday, October 29th. The stock market is now open. Wake your asses up. SoFi is down 5%. SoFi is down 5%. So the poll that I put out, 1,400 people voted, 56% said closer to 12, 44% closer to 10. It looks like so far the closer to 10s are correct. Wow, 5.5% on SoFi. This is the fourth quarter in a row. This has been a year now of dealing with a triple beat, raising guidance, and declining by 5%. I don't know how to explain it, but I guess it's SoFi. It's how it plays out. Damn, dude. The options are down 20%, bro. Holy crap. Look at this. We went from being up 140% to being up 82%. This is the beauty of leverage, folks. Look at that. We were up 4,700. Now we're up 2,900. Look at that. Well, that's when a stock falls 7.8%, what's going on? What the fuck? What is this? Dude, is it about to go below 10? Don't tell me. There's no way it's going below 10, bro. Below 10 would be, there's got to be some buyer stepping in. What the heck is going on? The volume on this right now is 21 million shares, and a significant percentage of them are selling versus buying, which is why you're down 7%. Holy shit. All right, we'll go back to SoFi in a second. Where's PayPal? PayPal, 78.80. PayPal's also down 5%. So the whole market's taking a little bit of a hit right now. SoFi's down 8%. The home builders are down 13%. DR Horton down 13%. Lennar down 7%. Google's up about 1%. S&P 500 down about 0.29%. Robinhood down about 0.52%. MicroStrategy is up 1.3%. Bitcoin just falling below 71,000 as well. So Bitcoin taking a little bit of a hit. McDonald's had good earnings. They're up 1%. Pfizer had great earnings. They're up 0.5%. Pfizer beat by $3 billion on revenue and almost 60 cents on EPS. So Pfizer really had some good earnings. They're up about 0.6%. CleanSpark's up 2%. BitX is up about 4%. Coinbase up 1.4%. Grindr, new 52-week highs, folks, on 1350. By the way, I pitched Grindr to Gali on the podcast we did yesterday. He actually liked the thesis. He didn't hate the thesis. So I'm convincing myself more about Grindr. I just hate this stupid price. I wanted to go back to $11 to actually start buying it, but I don't know. Maybe my thesis is right and it's going to be expensive for a while. But Grindr right here at 1352, Google at 169, Apple at 232, Neo at 572. China was up in the pre-markets. Where's China right now? FXI is slightly up to flat. Alibaba is up about 0.5%. So you got China going a little green as we open up the markets. Where's SoFi? SoFi's down 9.4%. Goodness gracious. Oh, Transmedics. Yeah, this one, TMDX. This one fell 30% yesterday. This one's down 30% right now. This one was up 60%. They missed pretty badly on their EPS and revenue. So they beat phenomenally past 3 quarters, which is why FinTwit started falling in love with the stock. It's like, this is a big retail stock. And then, bad miss yesterday. So they're down 30%. They create a platform to transport organs, like really important, valuable stuff in just humanity for this company to be innovating in this area. But the numbers weren't the best, so now they're down 30%. Okay, Robinhood 27.74, MicroStrategy 259, SoFi. Oh my God, it is 10 cents away from going below 10. Oh my goodness, bro. Oh my gosh. Look at this. We got Polo's bro saying SoFi puts printing. Yeah, if you bought some SoFi puts, dude, this cannot be headed back to $7, $8. I mean, that would just be, goodness gracious, dude. Oh my gosh. 9 point. This was not a quarter to go down 10%. This was not a quarter. Where's the VIX right now? VIX is up. VIX is at 20 right now. It's up what? It's up 2%. Yeah, VIX is not up that much. 1008 right now in SoFi. Robin at 2781. ITB, the home builders ETF, down 5.6%. Palantir as well, down 2%, 4411. And now for Palantir, it's not that crazy. I mean, at 45, it's getting up there, right? So going down 2% is reasonable, but everything's kind of getting hit. Where's Tesla? I don't even want to look at Tesla. I think Tesla's down 2%. Oh, okay. So good. Good skepticism went the other way. Tesla's up 0.2%. Now, Tesla did fall 2% yesterday when it was announced that some insiders are going to be selling $300 million worth of stock. I don't think that's that big of a deal, but that is why Tesla went from 270 to 262 yesterday. Right now, Tesla's flat. It was at 264. Now it's at 262. SoFi is 4 cents away. Oh my God. It's below 10. SoFi is below 10. How the hell is the street taking it down 11%? This can't be retail. This can't just be the shorts. This has to be a consolidated effort by the Illuminati to take SoFi down 11% right now. The fuck is going on, bro? This is insane. And I don't even want to look at my options, bro. We were up so much. Oh my gosh. Goodness. You guys ignored the technicals? Well, dude, there were other technicals saying SoFi's breaking out aggressively. So, I mean, it's fair to say the technicals showed that it could take a retracement, but other technicals show that this thing could pop up a bit higher on just good numbers. I don't think this is more technical driven, dude. I think this is the earnings growth. I think this is fundamentals at this point. And the fundamentals were good, but again, if you're just joining, the tech platform did not live up to expectations. Top line revenue growth was great. 756,000 members was great. EPS was great. But the tech side of the business is not putting up the growth. And Noto didn't really sound confident about it on the earnings call. And maybe that's why the street's upset. Maybe that is what's playing out right now. SoFi 1004. Where's PayPal? Who's buying this dip? Put in the chat if you're buying this dip. PayPal down 6%. PayPal lowered their guidance on Q4, so that's reasonable to see PayPal go down a little bit. Nvidia 139. Again, entire market's red, so that's not helping SoFi either. IWM is flat. By the way, the next 6 weeks are the best period historically for small caps. So the next 6 weeks are the best period historically. Oh my God, JetBlue is down 12%. What the hell did JetBlue say on their earnings? These guys were up like 20% over the past 2 weeks. But yeah, the next 6 weeks will be good theoretically for small caps because historically they have been as well. JetBlue lost $60 million. Operating revenue of $2.4 billion, which is up 0.5%. Operating expenses of $2.4 billion as well, which is a decrease of 4.2% year over year. That might be hurting the other airlines as well. JetBlue down 14%. United Airlines as well, down about 0.28% right now. Whereas Delta is slightly up 0.09%. Where's Bitcoin? Are we still at 70 on Bitcoin? Are we still holding on to 70? Bitcoin 71. Bitcoin's being resilient. 71, not bad. Bitcoin's being resilient here. Not getting hit too badly. All right, is SoFi still below 10? SoFi holding on by a thread at 10.05. Who is buying the dip? Who is buying the dip in the chat? Riley said he bought 500 SoFi. I like the earnings. Chris said bought the SoFi dip, but waiting for bigger drops. I think that's fair. Philip said just bought 5 shares of SoFi. Bsoft says sold put, so technically I'm going to be buying the dip, going to be assigned at 10 at this rate. I mean, dude, I don't think you should have to be assigned at 10. That's tough. But granted, if you roll those, I think you should get a decent premium too, because the strike is basically at the money. So maybe rolling that could give a good premium and buy you some time. Bitcoin 71.4. Bitcoin's holding up, even though the rest of the market's kind of taking a dip right here. Bitcoin is indeed holding up. The other thing about SoFi that's really interesting on these earnings is that, again, they are showing. So here's the thing that I want to show you guys. This is another thing that could add some clarity for why SoFi is down. SoFi added 754,000 members. Now, 2 things. They did not give us the monthly active users of these members, which to me is a little bit of a red flag, dude. Every single tech company gives monthly active users, like every single one of them. Even Robinhood. So if you don't give monthly active users, I question how many of these 9.3 million members, like I'm a member of SoFi, but I don't open the app. I don't use it. So the question is, how many people are like me that are not active? Second of all, if I'm not reading the numbers wrong, correct me in the chat if I'm wrong. SoFi did 2.7 billion of deposits this quarter, which is good. But guys, Robinhood did 13 billion last quarter. They're projected to do 11 billion this quarter. So the disparity between SoFi and Robinhood on deposits, again, it's not to compare them, but it's just bringing some color. SoFi is adding 750,000 members, and they're bringing 2.7 billion in deposits. Robinhood's adding roughly the same, if not a little bit lower, and they're adding 13 billion or 11 billion in deposits. So the actual deposit inflows of a fintech company, which defines the overarching thesis, which is why Robinhood is giving so much damn money to get all these deposits, is the lifeline of the business. And I've said this for the past couple of months now. SoFi, those deposit numbers are weak in my opinion. In my opinion, those are relatively weak compared to some of these other companies and what they're bringing in. Now, is that a thesis breaker? Of course not. But it is one thing to think about when you're thinking about where's all the money going in. The same Robinhood user theoretically is the same SoFi user. But if their money's going into Robinhood, even if they have a checking account with SoFi, that's a problem, right? That is somewhat of a problem for overarching growth. So again, look, not a thesis breaker, but it's one thing to take into account. The deposit growth has not been like astronomical for SoFi, and neither is the tech platform. So then what has been astronomical? Loan originations, which have been amazing, but those are not businesses that the street values at, very high price earnings, because at the end of the day, it qualifies you to be a bank. SoFi right here at 10.02, down about 10.3%. Where's DJT? DJT is halted. Wow. The Trump stock is halted at 14% up on the day. DJT now for the week, which again, to me, this is the market saying they think Trump's going to win, or at least a segment of the market. DJT is up 209% year to date. Over the past month, it's up 236% because it fell to $16. Over the past 5 days, it's up 52%. Today, it's up 14%. It is halted right now. Does Truth Social deserve to be worth 10 billion? By the way, Twitter is worth 9 billion on paper. I know Elon paid 44 billion for it, but on paper, Fidelity has it valued at 9.2 billion. That means DJT is worth more than Twitter, which is kind of crazy. Probably doesn't deserve to be worth 10 billion, but again, people are buying it to support Trump, which seems like the reason why it's going higher. Waste Management, we finally found their earnings last night, folks. I stayed on the market close till 5 p.m. trying to find their earnings. They came out a bit later, but Waste Management did put up some decent numbers, beat on EPS and beat on revenue. They're up 5% right now, or up 4.2%, which is good. Nice to see that Waste Management, steady stock, 1.38% dividend, is up 4% on some decent numbers. Google right here at 169, trying to crack that 170. Bitcoin still above 71,000. Robinhood 2777. Alibaba at 100, Tesla 262, MicroStrategy 262 as well. SoFi 998 continues to be below $10, now down 11% on the day. Oh boy. Oh boy. Oh boy. Oh boy. Yep. SoFi continues to take a hit. Where's PayPal? PayPal and SoFi kind of following each other right now. PayPal is down, 7%. PayPal was down 4%. Now it's down 7%. Where's Square? Square might be boxed in with the fintechs. It's down 1%, not down as much as PayPal and SoFi, but both of those getting a nasty hit. Again, both earnings for these companies were not bad, but it looks like some part of them, whether it's Q4 guidance being lowered in PayPal or SoFi not having enough tech platform growth, is what the street is upset about. All right, that's what we got on SoFi. Doug says, amid SoFi spending money on celebrities and athletes to get $1,500 accounts, Hood is giving money to members to join and get $2 million accounts. That's another big point. I mean, that's undeniable right now. That's something that's a very good point by Doug at the end of the day. I don't love the celebrity endorsements by SoFi. By the way, I also don't love the celebrity endorsements by Robinhood. They're not really celebrity endorsements, but they're like putting the jersey patch on these NBA teams. I don't love that, dude. I don't really think we need to sponsor the Miami Heat to grow users. I feel like that's like a brand positioning thing, which is fine. If they got a good deal, then it's okay. But SoFi has the stadium. They have some partnership with the golf league or whatever. I don't even know what the golf league is called. And they do these little partnerships here and there. Venus Williams, all this stuff. I don't love that stuff unless it brings in really big accounts. And it's undeniable that Robinhood is bringing in huge accounts by paying for it. Now, Robinhood's paying for it. They're paying a hefty fee at 2%, 3% matches that they're giving to these multi-million-dollar accounts. But when you bring in millions of dollars of deposits by people who obviously have the income to be able to put more of their millions of dollars into the platform, then the LTV on that CAC seems incredible. Whereas for SoFi, that's not necessarily the case, right? And so I think the deposit strategy as well from SoFi needs to be figured out if they're going to be doing all these celebrity endorsements. DJT still halted right now. It fell from 14%. Wow, it was unhalted, fell to 8% from 14% up. So it fell 6%, then it got halted again. All right, so DJT seems to be getting some notices by the SEC right now as it gets halted. SoFi now 979, down 12.5%. You know what's the triggering thing about SoFi? JOLTS is coming out in 15 minutes. The triggering thing about SoFi is that people spent so long from 6 to 8 and really from 6 to 7, like over 18 months, that I think people are afraid that if they get back there, they're never going to leave. It's kind of like you're going to be stuck in purgatory again because SoFi does not have catalysts ever. They never have a catalyst. This was a technical breakout from 7 to 11. So the fear is if they get back to 7, get back to 6, get back to 8, are you stuck in purgatory and you're selling covered calls and cash secured puts, wheeling this thing for the next year before you get any capital appreciation? And that could also be a reason why people are selling right now because people are like, screw this, I'm out. I'm not going to wait for this thing to bounce back out into normalcy if we're going to be stuck in purgatory again with SoFi. So I think that could be another reason, why people are a little scared if it falls back to these levels. Why was it up in the pre-market? That's what happens every earnings. It's up in the pre-market, and then after the results come out or after the market opens, something at 9:30 happens, and then the Illuminati gets involved and they have their roundtable discussion and they kind of come to a conclusion on what percentage point they want SoFi to go down. And I guess this time they picked 11, and actually they picked 12. Sorry, because we're down 11.9%. And then they make it happen. And so, dude, those $15 calls for June 2026. Oh my God, those are probably down today. Same with the $10 calls. My dad, let me check my dad. My dad has 8 of the $10 calls. My dad was so happy SoFi was finally going up because he was down like 1,500 on these SoFi calls for like 6 months, and he was so annoyed. Right now he's down 25%. So he's still up $422. Yesterday he was up $1,100 on the $10 2026 January call. I will definitely be getting a call from him later today. He's like, what the fuck? Dude, every time a stock falls, it's so funny because he's like emotional about it. He's like, what's going on? Why is it? But then when a stock goes up, he's also like, why is Robinhood up right now? I'm like, Dad, like this is like the market. Like this, it happens. Like things go up, things go down. But he's like so into it, even though he's not following it religiously, he's like so into it when he sees these big moves. SoFi right here down about 10%, still below $10. Maybe we see a reversal later throughout the day. Bitcoin 71,000, Robinhood 2786 on the day right now. Amit is a conspiracy theorist. Correct. Yes, Amit is a conspiracy theorist. Thank you for the $2 super chat. Experimented. I told my dad though about the election betting market yesterday on Hood, and he was like, "What?" I was like, "Yeah, you can like buy Trump or buy Harris." He's like, "You can do that on Robinhood?" I was like, "Yep, that's why it's up 3%." He was like, "That's why it's up 3%. You can bet on the election." I was like, "Yeah." I was like, "I think they're trying to go for sports betting and online gambling and all this stuff." And he was just like, "Damn, that motherfucker Vlad doesn't sleep, bro. That boy keeps executing." And so, I mean, it's even impressive to people like my dad, right, that are just seeing the rate of innovation from this company, which is another bear case on SoFi. I mean, again, I don't mean to be bearish here, but when a stock's down 10%, we got to explore some of the bear cases. There's no innovation in this company, in my opinion. Now, SoFi on the earnings call, they said, hey, we're launching this SoFi Plus program, which is probably going to be $5-6 a month. I am very skeptical of a SoFi Plus program because it's already so hard for people to sign up to Robinhood Gold, which is basically what SoFi's copying, right? The Robinhood Gold membership program. It's not easy, bro. And you got a lot of people that are I get a lot of DMs saying, hey, if Robinhood decreased the APY from 5% to 4.5%, why should I pay $5 a month for gold? So like the subscription product really grew for Robinhood because of these high interest rates where they were able to offer a high APY. As that APY lowers, which SoFi is already at 4.3%, the necessity to subscribe to pay XYZ dollars a month also tends to get lower. And so the question is, what do they add to SoFi Plus that makes it so exciting for people to pay $5-6 a month on top of their brokerage app? And I don't know what the hell SoFi is going to introduce. Maybe they have some discounts on loans. Or I don't know what they're going to introduce. But even Robinhood, right? Robinhood has to really market gold to get people to subscribe. And more people are thinking, hey, what's the benefit if you're lowering the APY? So I'm not the most bullish on their 9.4 million members converting to SoFi Plus when we don't even know how many of the 9.4 million members are active. Like imagine there's only like 20% that are active. And if there's only 20% that are active, you're expecting a conversion rate of maybe 5 to 6% on that 20%, because not all of them are going to sign up for some $5 a month program. Like, people just, don't want to pay for stuff. So I don't know. It's an argument. Steve Smith says, admit you've been away from SoFi for a while, not to see what they're developing. Please educate me. I would love to know, because we can't even sell covered calls or cash card puts on the platform right now. So I don't really know what they're developing. And if you're going to tell me alternative investments, I do not want to hear that argument, because no one gives a shit about investing in paintings. People care about investing in the stock market. And I doubt the margin that SoFi is getting because you bought a piece of a Pablo Picasso is that aggressive for them to make a difference in their net income. So it's like, this is always the issue I had with SoFi. Like, why are they going after investing in paintings when people can't sell covered calls on their platform? Like, what is going on? Like, the product roadmap has always been so weird to me. But I did feel at $7, it's undervalued and it's been stuck in a channel and it should break out. And it did break out. But then you're reminded on earnings that there are some parts of the business that are still missing. And that's why the stock tends to sell off from here. Paul says, I've been griping about options for the past 2 years. Yeah. And again, I don't want to make this a SoFi bearish stream. I have SoFi. I'm not bearish on SoFi. It's just, this is objective in terms of critiques around the stock is one of those things we have to analyze, when it falls 11% and something might be missing on these earnings that the street might care about. Their call mentioned that small business banking is coming. Well, here's the other problems. This is the thing that got Steve, who's a good friend of the channel, so pissed off about SoFi. SoFi introduced small business banking in collaboration with American Express, meaning it's not a vertically integrated product. Meaning, if, for example, if I go to Bank of America right now and I want to open a business account for my LLC, I can do that. I've done that. I did that 7 years ago, right? I've always had a LLC with Bank of America. I've wanted to transfer to SoFi for like the past 3 years and just use their product as my small business, because there's no need for me to be in Bank of America, but they don't offer that. A couple months ago, they introduced it in a third-party collaboration with American Express, and Steve was just so pissed off because he was like, why are they not integrating that vertically inside of their own platform so they can go to SoFi, say, hey, I have a small business, sign up, you put in your tax ID number, boom, and then within 5 days, you have a small business checking account on SoFi. That's the type of innovation that you would expect from a company that wants to control the online banking infrastructure and the ecosystem, and that's just not what we're getting right now. Tesla at 261, Transmedics down a full 30%. Robinhood goes green, $28.06. Robinhood up about 0.65% of the day. MicroStrategy 265, new all-time high for MicroStrategy, up 3.55%. By the way, another stat on MicroStrategy that's very important. Some people are saying MicroStrategy is overvalued right now and it's overpriced against its alpha, against its premium for its net asset value for Bitcoin. They are probably right. However, in 2021, MicroStrategy traded at a 6x NAV against Bitcoin. Right now, it's 3.5x. So this thing could get crazier than we expect if Bitcoin does what it can do. And although MicroStrategy, yes, it is like really trading at high levels right now, 2021, it was trading at even higher levels. And so you might see MicroStrategy get back to that 6x NAV or even higher if Bitcoin, goes kind of crazy, or MicroStrategy could crash 20%. I think any of those options are possible, but if Bitcoin keeps going up, maybe there's a world in which MicroStrategy continues to achieve a premium that is pretty high on its Bitcoin in comparison to the Bitcoin they have on their balance sheet. 71,615 for Bitcoin. So Bitcoin's still maintaining 71,000, which is not too bad at all right now, and holding its momentum. Steve says you're being directed to Amex and Novo. They are crawling before running, as Noto said today. So that's fair, Steve. So that's a very fair, ironically, your name is Steve as well, Steve, but that's fair. Your point is, hey, you're being directed to Amex if you set up a small business account versus vertically doing it through SoFi. They're crawling before they're running. Very fair point. I think the problem is shareholders want to see them not just run, they want to see them fucking go faster than Usain Bolt. All right. Like, shareholders have been stuck for almost 3 years now in losses on SoFi, unless you got in at the 6-7 level. Most people got in like Palantir, right? Most people got in on Palantir at 25, 26 like me. We had to go through the $6, $7, $8 phase, and now we're out of it. Same thing happened with SoFi, but that phase of being stuck at $6, $7, $8 didn't really change until recently. But you need to be running, right? You can't be crawling when it comes to getting that type of growth. Now, look, if you have a 10-year horizon on SoFi, they can take their time. They could be a snail, because in the next 10 years, if you wake up, SoFi is probably higher than $9.92. But you got a lot of people that have been waiting for 3 years, and they don't want to wait, at least not as much anymore. So those are my thoughts on the small business banking with SoFi. But look, eventually, if they vertically integrated, that should be a good thing. The question also is just the opportunity cost of time. How much time are they taking, which would lead to users just doing other things on other platforms and then not switching by the time SoFi ends up rolling this stuff out? I don't think it's going to be the biggest opportunity cost, but right now the street may be thinking that. Down 11.2% on SoFi, Tesla 259. Down below 260. Bitcoin still holding 71.6, which is not bad. Where is Palantir? Are we below 44? Palantir 44.63. Wow. Pretty freaking resilient, dude. Market's red. Palantir holding on not badly. S&P 579. For those that are just joining, Alex Karp did sell 3.7 million shares of Palantir yesterday. Talked about that in the beginning of the show. Look, I believe he's taking some profits, and it's fair. Stock's up a lot this year. The beautiful thing about this is that here's the thing. Although you could say it's bearish that he's selling, which I totally understand that argument. That's very fair. The one thing you can't say is that you don't have the opportunity to sell with him. And that's been the theme of Palantir over the past 2 weeks, is that although insiders have been selling, the deep liquidity of this stock is making them sell at prices that are actually lower than where the stock goes to over the next 2 weeks. His original sell was at 35, Peter Thiel at 37. They kind of missed the run to 45 on those sells. And you can sell right now at the same exact price at a better price than Karp sold at. So it's one of those things where if you hate insider selling, you can de-risk your position as well. If you buy into the philosophy that insider selling is just a natural part of a company's growth and that at the end of the day, Karp's been there for 20 years, he's going to take some profits, it doesn't matter too much, then that's another way to think about it as well. Q3 earnings is going to determine everything about Palantir, and now we just have to wait until November 4th to see what's playing out. At what point should we be concerned about this 10-year? Okay, that's a very good question, Danielle. So what Danielle's talking about right here is the 10-year yield, which, wow, is up again today at 4.32%. This is probably why the market is selling off as well. I think 4.5, which was the levels we were at in October of last year when the stock market, when the S&P was at 410, now the S&P is at 580. It gets a little concerning because you have the same type of yield in a year that hasn't changed, even though interest rates have come down. However, I do think this 10-year starts to decrease when we get another rate cut with 25 bips. The reason the 10-year is not going down, again, it's kind of a confuddled reason. The reason the 10-year is coming down or is not going down is because the economy is good. We're adding jobs. We added 254,000 freaking jobs last month. So when you're adding these many jobs and the economy is resilient, the expectation is that inflation will be here for a little bit longer. And as a result, the 10-year starts to get sold off, which increases the yield on the bond. But that's a good reason that the yield is going up. It's not like the yield is going up because people are afraid of equities and they'd rather hide out in the 10-year. It's like there's kind of a unique reason for why the yield is going up, which I don't think is the worst thing in the world. But if that yield gets closer to 5%, that's when I think it gets a little... all right, what's going on here, right? Why is this yield not coming down? I think after another rate cut, it should come down, but we're going to have to see when that happens. We got JOLTS in 3 minutes as well, so we'll see how that affects the 10-year and the broader market. Where is Hood? Hood is 28.14, up 1% on the day. Not bad for Robinhood. Again, this is being helped by two things. One is the election betting market. That just is a net new line of revenue that Hood is basically previewing to the street. And then Bitcoin, obviously Bitcoin right here, 71,778, 72 would be incredible to see on Bitcoin. But that also is helping Robinhood 71,674 right now on Bitcoin. And the selling isn't tanking Palantir 100%. Yeah. The fact that Karp was able to sell 4 million shares yesterday and it didn't tank is also pretty incredible, right? It's also important. This argument you keep making, Amit, misses the point, Amit. The point is you should be worried and not sell with him if you want. Well, I take a different perspective on this. At the end of the day, I'm not worried about Karp selling because he's been there for 20 years and the stock is up 150%. I mean, you got to ask yourself, if you were the CEO of a $100 billion company that has I don't know how much his worth is, but let's multi-billion-dollar worth, would you not take some off the table? Like that's just prudent timing and risk mitigation that I think every CEO has to do. By the way, it's not just Karp. Zucks is selling. Jensen is selling. Bezos is selling. All these guys are taking some profits. And does that mean all these stocks are uninvestable? No, of course not. But it means these guys have heavy stakes and they're taking profits, which is reasonable to do. So I don't think it's bearish at all because Karp was selling at $8 as well, right? Because Karp was there for 15 years and at $8, he finally got some liquidity, even though the stock was down 80%. So I don't think that's bearish. What I do think that's important to understand is that he's not selling and leaving you holding the bag because the bag keeps getting bigger, even though he sells because the stock keeps going higher, right? And so it's one of those things where, look, either we get humbled after Q3 and he was selling and the growth didn't live up to the expectations, and then you could feel some type of way. But if the growth lives up to the expectations and we're flat, maybe down a little bit, or we go up, then him selling really is not that big of a deal to me because he's made shareholders rich along the way. Again, he's taken shareholders on the journey. It's not like he's cashing out and people haven't made money. A lot of people have made money if you invested at any point this year in Palantir. And so at that point, I think a CEO deserves to take some profits, especially if they've been there for 20 years. All right, so we've got the JOLTS report coming out very soon. Let's pull up these numbers. The street is expecting 7.8 million jobs to be available. 7.8 million jobs to be available. Sorry, 7.9 million they're expecting to be available. Last time we had 8.04 million. So if that number's higher, the 10-year could go higher, but also that could just be healthy for the market because there's more jobs that are available if you believe these job numbers. Oh, that is a miss. Whoa, 7.4 million. And they revised the last month from 8 million to 7.8 million. Whoa. That's a hell of a miss right there. Where's the market right now? S&P 500, where is it at? S&P is kind of flat. Bitcoin is going higher. Bitcoin doesn't care. S&P is flat. S&P is down 0.2%. A little bit more red than flat, but that is indeed a miss. That is a miss. Okay, so on to JOLTS. These are the job openings in America. Last month, we had 8.04 million jobs open. That number got revised to 7.86 million. So 200,000 jobs disappeared. Market expected we would have 7.99 million jobs open. Currently, we have 7.4 million jobs open. The 10-year just went down slightly, 4.32 to 4.3. But that is a hell of a miss on JOLTS. Derek, thank you for the 40 gifted memberships. Again, Derek, I appreciate it. Derek's been giving like 50 gifted every single day. Derek, thank you so much. 40 of you just got a gifted membership randomly. You'll see it in your YouTube right now. If your name has the green highlighting, then you just became a member. Thank you, Derek. I appreciate it, brother, for the 40 gifted memberships again on the morning. So Bitcoin doesn't care about this. Bitcoin's fine. S&P is also fine. Robinhood's at 2831. Robinhood doesn't care. Bitcoin looks like it wants to head to 72,000. Whereas IBIT, BlackRock's ETF is at $40.97, up 3.2% on the day. Whereas MicroStrategy is at 266, up another 4%. SoFi is still at $10. So everything is red today except the Bitcoin proxies. And that's because Bitcoin is outperforming right here at 72,000. Which is not too bad. Michelle says, I need headphones. I'm walking around Walmart listening to. Michelle, you need to keep me on speaker and need to let everyone know that Bitcoin is at 71,891. You got to be unapologetic. And if someone asks, just be like, I'm listening to the market open. Watch your mouth. Okay? I'm listening to the market open. Watch your mouth. 71,000 on Bitcoin. MicroStrategy at 265. Robinhood 2826. SoFi still below that $10 range. And Palantir right here at 44.65. Let me see if I can get the job numbers from CNBC, get their update on it as well, and see what they have to say about these JOLTS. This is a surprising JOLTS number. All right, here we go. We got it. Let's see what they have to say. Here we go.
This now becomes the lowest read going back to January of 2021. In terms of the Conference Board consumer confidence numbers, they are trickling in. I don't know if there's an issue this morning, but headline number expected to be in the vicinity of 99.5 comes in much, much better than expected at 108.7. That ends up being the best level since January of this year. It's the second best level of the year. And if we look at present situation, it comes in at 138. That follows 124.3. That's a blowout number. That's the best since May of this year. And finally, what may lie ahead in the form of expectations, 89.1 blows away the rearview mirror at 81.7. And 89.1, well, that becomes the best level going all the way back to December of 21. So we see that yields move down a bit. Now they're coming back up. But maybe the most important number this morning was much earlier. We had an advanced trade deficit that came in the second highest level ever going back to 1989. We could talk about what the election may do ahead. But boy, in the here and now, we have some issues going on. Imports much stronger than exports.
Okay, so again, the jobs opening was the big numbers there. The imports, exports numbers, those are not as serious. The main thing was the job numbers, but the street doesn't care. The market doesn't care. Bitcoin is $20 away from 72,000, and the S&P is about to be green, folks. So, okay, so let's talk through this. Why does the market not care about us losing these many jobs? And not literally losing these jobs, but on paper, these jobs are not available. One could argue, here's like a bullish argument, that the jobs have been filled. And so if you have 7 million jobs open, I'm just putting random numbers, 7.2 million jobs open. Now you have 7 million jobs. Theoretically, you hired 200,000 people, right? That's one argument you can say. So maybe that's kind of bullish. Another argument that's more bearish is that those jobs were never real jobs. They were ghost jobs. They were kind of these like random applications that people put out, but they were never actually fulfilled, or they were government jobs that the government never ended up hiring people for. And so those jobs go away, which means they're unfulfilled, which means we have less jobs available, which is bearish. The other element to the bullish aspect is we have less inflation. We have less jobs. We have less money that's being spent. We have less inflation. As long as we can balance that with healthy growth, which has always been the tight line the Fed has had to walk. How do we make sure inflation goes down, but growth still goes up? Then that could be an argument that for all the people saying, oh, we're not going to get another rate cut because the economy is too good. Well, we just got to miss on the jobs report. Maybe the economy is not that good, which means maybe inflation will go down. And maybe that's another reason from a labor market perspective for the Fed to cut rates. So I think that's kind of like the bullish thesis on this jobs number. And that's why you got the S&P that's barely down. It's 35 cents away from going green, which might be one of the things that allows the S&P to go higher. Doug says we all know those job numbers were fake anyway. That is fair. Chris says seasonality. Seasonality is another argument that is also fair as well. I would be kind of 50-50. I would say some of those jobs were definitely fake, but a lot of those other jobs maybe got filled. And because they got filled, they're not there anymore, which is not a bad thing because that means more people have jobs. But the street doesn't care. It looks like the street's kind of creating their own narrative around this right now, and markets are fine with the jobs report that we got right now. Bitcoin's doing great on this. I think if we accept the narrative that inflation is going down because less people have jobs and we're going to get more rate cuts because of this JOLTS number, that is actually a logical syllogism to assume Bitcoin should go higher because, again, more rate cuts opens up more liquidity. So, theoretically, that could be a reason why Bitcoin is getting some momentum right now. Amit, can you call me? Yes, let's call in one of our favorite contributors onto the show. And let's get his thoughts on these numbers. Chris, hold on. I got to find my phone holder. Why do I always lose this thing, bro? Where is this thing? Hold on. It's got to be right here. I found it. All right, here we go. Let's give Chris a call. Let's get his thoughts. All right.
Hey, dude, how's it going?
Chris, what's up?
Dude, one thing I really think that, I'm pretty libertarian when it comes to a lot of things, like government regulation wise, but one of the things that we really, really need is employers have to publish real open jobs.
Agreed.
This nonsense where employers will open these ghost jobs and all these people will waste their time applying for a job that they're never gonna call back on, and these guys are just hoarding and stacking resume. That's really, really terrible for employees. Like, I've been in that position where I've gone, into the job market and I've applied to X many jobs and I'm wasting my time because these jobs don't exist. And that happens at the federal level, sometimes at the state, and especially at the private sector. It's like, it's really bad. It's really demoralizing for the people that are trying to apply for a job. It's just, I'm not a fan of how these corporations, they try to do this nonsense, and it also distorts reality sometimes as well.
So what's your take on this now? The JOLTS, they lowered 8 million from last month. It was a nasty miss at 7.4 versus 7.9 million this month. Is that bullish or bearish from your perspective?
I mean, it kind of depends on which side of the market that you're looking at. So, a lot of the people that we're constantly seeing that 10-year go from like that three and a half handle to now almost being at that 4.3%. That rapid rise is because everyone's like, oh, well, look, the economy's doing really well. Everyone's got jobs. There's more jobs. There's plenty. So what we're seeing now is, a little bit of like, in my opinion, this is good because there's like a little bit of relief, right? Saying, look, the economy's doing okay, but it's not like supercharged, which means that naturally inflation should be coming down next year. One of the biggest fears that the market's been having for the last, I would say 30 days is reacceleration in inflation. If job numbers like this keep coming up, that disinflation and I don't want deflation, but disinflation is going to be the next thing that's coming up. So in my opinion, it just kind of depends on how you're positioned. If you're like uber bullish the market, you might get smacked a little bit, because you're more short-term focused. But if you're long-term focused, this is actually good. This is like just things are balancing out and normalizing a little bit. So.
Yeah, I agree that there's a bearish way or a bullish way to interpret it. It seems like the market right now is reacting in a kind of indifferent way. But I definitely agree with you, dude. We got to have a better way to track jobs because right now it's like craziness in terms of.
Yeah, I mean, dude, when employers can just basically go in 3 clicks and boom, they got a job posting. And then, they just hoard all these resumes. And the way they do it is that everything is AI algorithm based too, where instead of actually applying, like interviewing people, what they'll do is they'll be like, if you use this keyword, it'll let the application go through, and it's so freaking retarded. Like, why would you set it up? Like, you cannot tell. Like, I've been in the shoes of a person who's hiring someone. I saw someone on paper who was completely the best person you could hire. But the minute you put them in a real world scenario, they fucking absolutely suck. Like I still remember this one guy we hired, and literally like 2 months later, me and my boss were just like, we fucked up.
Yeah.
Like, this guy is a complete fucking moron. Like, I mean, yeah, on paper he looks like a genius, but like in reality, this guy is a freaking moron, And it's funny because like all the other staff members were like, y'all hired him? Like, what is wrong with you? And the thing is, like, you don't really know a person until you put him in that scenario. I mean, luckily he didn't make it through probation because that's one of the great things about certain jobs. Like, you have like this window where you can still let someone go. But the point is, we wasted our time, and you know what really sucked? We had a budget for a new line for that position. So when we did not hire him, we had to apply again for his position.
Wow.
So then we had to wait 6 to 9 months to get it approved again to actually put it out there. And so it ended up causing us a year's worth of like additional overtime because once again, the resume was good. And the freaking HR department basically sent us, quote unquote, all the ones that were good. So now I'm like, just send us all the resumes. Don't fucking send us like, the resumes that AI thinks are good. Fuck AI. I don't care about AI. Send me the actual goddamn resumes, and I'll look through myself. If we have to spend 2 hours, 2 days interviewing 30 candidates, I'd rather do that than trying to, AI generated return bullshit that they have. I'd rather get an older person, believe it or not, with more experience, who I know can be trusted, than someone who on paper went to like the best schools, but you put them in a real world scenario and they're just garbage.
Yeah.
So.
All right, let me get your reaction to some of these stocks. SoFi down 8%. What are your thoughts?
People have to really look at tangible book. Just look at the book value and then base your thing on that. So if the rest of the banking sector is trading at 1 times book, then SoFi's a little bit over that. So I mean, it's good. The company's doing well. It's going in the right direction that it's supposed to. So anyone who is a SoFi shareholder, just know that you're in a good company with a good leader. You're not in a shitty company. SoFi is not a shitco. I know some people will interpret SoFi as a shitco because it came out through a de-SPACing and Chamath the scammer basically put it out. But I don't think people realize that they put a really good CEO. I mean, dude, come on. We have to admit that Chamath is a scammer now.
Hey,
we really have to.
I mean, you said it, not me. I'm trying to interview him one day, so I'm not saying anything.
Listen. Look at Clover. Look at what do you call it? Virgin Galactic. Remember all the SPAC shit? He was the one. He was the SPAC king, quote unquote. He was going to be the next Warren Buffett, right?
That is true. He was comparing himself to Warren Buffett at the time. Like he was self-proclaiming that. So that is true.
Right?
You know,
Remember what was it?
Open Door.
No, Open Door's another one, but remember his whole thing with, I forgot what they were called, like his head of FACIA 1, head of FACIA 2 bullshit. I forgot what the SPACing funds that he had.
I think he was calling them IPO-A, IPO-B. You talking about that?
Yes. There you go.
Yeah, it was like a new letter every time he IPO'd something, and it was like this big deal. And it's like they were not good companies. Okay, what about Bitcoin 71,000? You got bullish on Bitcoin a couple months ago. What are your thoughts on Bitcoin right now?
I mean, so there's still people on YouTube and on Twitter that will say, well, Bitcoin is not real, blah, blah, blah. And I'm like, dude, baseball cards are only, just pieces of paper, right? The key is the other person on the other side valuing it as such. So, the thing with me and Bitcoin and why I'm bullish on it now versus my past is because in the past, I was like, there's not enough people that are really going to give a shit. Dude, there are Bitcoin, like, maximalists right now all across the government, all across the private side, all across like the public sector. So gradually Bitcoin has actually become a store of value, right? So when more and more and more people adopt it, it becomes more and more valuable. I mean, think of gold. It's just a shiny rock, right? That's all gold really is. But if the person on the other side is valuing this and saying, wow, I'm willing to pay $2,000 an ounce for this shiny rock, that means it's worth $2,000. It's like the Van Gogh, too. Like, Van Gogh is nothing. It's just a fucking guy who's crazy, painted some shit. But the thing is, on the other side, if someone says, oh, no, this is a $50 million painting, that becomes a $50 million painting. So Bitcoin, as it gradually becomes more and more associated with value storage, the value is going to keep rising. And especially when it comes to like a currency hedge, because of the scarcity of it, you're going to see this thing keep going higher and higher. I don't know where Bitcoin tops off, by the way.
But you think this run to 70 is you don't think it's BS, this run this year? You think it's based on monetary policy creating too much inflation?
I think so, yeah. The thing is, like, dude, governments are using this as a store. Like, they're storing this shit now. Just think about it. There's companies out there right now that are holding Bitcoin on as reserves right now. Like, there's ETFs now. The freaking BlackRock, Larry Fink, is on the Bitcoin train now. Dude, Bitcoin is going to keep going higher and higher. The only thing that worries me about Bitcoin is something along the lines of like the U.S. government banning it because like it's competing against SWIFT or something like that. But that is even off the table now. I don't even think that's even a question anymore. And then you have like politicians utilizing the Bitcoin community for a political vote, which is another good thing because that also insulates them against future legislative attacks, because people are like right now, both Kamala and Trump are jockeying to be crypto maxis. When did you think that was going to happen? That presidential candidates were going to talk about Bitcoin being what is that thing called, like a policy topic?
That's a fair point. That indeed is a fair point. Real quick, Chris, before we continue, guys, we got our good friend of the channel who did us a little bit of a favor today. And we got Mr. Derek Wall buying 50,000 shares of SoFi at 10.26. So that's the screenshot on the screen. 513 grand at 10.26. Maybe it'll be a hell of a buy. Maybe he's gonna have to DCA in the 950s if we get there. But we got some people buying the dip on SoFi. All right, so Chris, then outside of SoFi, PayPal, I don't know if you saw their earnings, but they're down 7%. Any thoughts on kind of why they're taking a hit?
I mean, I didn't really look into it that much right now. I literally just woke up. I'll have to deep dive into their numbers and see what's going on. But I mean, PayPal is a value play. They're still generating significant amount of cash flow. They're buying back shares. They are a more mature business, but that doesn't mean that they're not valuable, right? Yeah, maybe they don't have the explosive growth in user numbers like they did in the past, but that's not a bad thing. I mean, there's tons of companies that are more value centric, that have the ability to, do the buybacks, so that this way their share price can keep going higher and higher. So I think what it is when you get to a certain level of maturity, you need to figure out a way to generate shareholder value. And I think SoFi, not SoFi, I think PayPal's doing it. So there's nothing to really complain about and nothing to really worry about.
Yeah, I mean, they bought back almost $2 billion worth of stock. I mean, like, I think they're going to be okay.
Yeah.
Okay, last question for you, real quick. AI sentiment, has anything changed over the past week, or you're still AI is okay, and end of the year, as long as rates come down, AI should be fine?
I mean, for now, AI seems to be okay. There doesn't seem to be any like material weakness that's coming along that is, like glaringly obvious. But that's the thing. Whenever these, quick rises happen, it's rare to find that one trigger point that causes a cascading effect. Now, there are certain signs that are worrying. Like here's an example. A lot of people are going heavy in nuclear because Amazon said that they want to bring nuclear to the forefront of powering these data centers.
Right.
And the thing is, a lot of these companies, one, they're all pre-revenue. They're not even generating any income yet. They're still like, some of them are still in like, explore, like, what is it, in like research mode, right? And they're getting like $3 billion, $4 billion valuations on it. They don't even have a product yet. So nuclear also is very regulatory intensive. So this is one of those times where when you see people trying to do proxy plays on AI, it makes you think like, oh, maybe there's some froth there. Like, look at Oklo. Did you see that? Like,
Yeah.
That thing is just skyrocketed, right?
Oh, Chris, give me your thoughts on Google. What's going on with Google today? I mean, like, they have earnings after the bell. This is gonna be a big one. Gut feeling, up or down after earnings?
Sentiment is against Google, man. Everyone seems to be coming for Google's monopoly. So you got Zuck just said that he was going to work with NVIDIA to launch another search platform, right? And then you had Perplexity gaining as much market share in terms of total search. So the main business, the monopoly business, is something that Google is going to have to address on how it keeps that moat alive without the government. I mean, the other thing is like it could do monopolistic things, but then the government, it would be inviting the government to regulate the shit out of them. So they're kind of like, it's really bad because it's almost like they've got one hand tied behind their back and saying, okay, go fight like 5 people. That's what Google is in the middle of right now.
Right.
They're still a great business. Don't get me wrong. You've got a lot of secondary and tertiary businesses that are just hella valuable, like YouTube and Google Maps and all this other stuff. Like my entire ecosystem right now is still Google powered, which is I still have Gmail. I'm not gonna get rid of Gmail. Like I've been using Gmail for, I don't know about you. Like, what do you use? Gmail, right?
I use Gmail. Everyone uses Gmail. At least I do.
Like when you travel somewhere, you're not going to other maps. You're going to Google Maps. You're on YouTube right now. So I think what it is when you start to see people switching away from Gmail and Google Maps and YouTube, you could probably say that days of Google are behind it. But as far as I can tell, the ecosystem of Google is very strong. They still got cloud computing. So, for the like value investor, Google makes the most sense out of the Mag 7. The only thing is, in the short to medium term, you may end up seeing valuations stay depressed primarily because it's dealing with all that competitive pressure from outsiders, but then also from that regulatory pressure saying that, hey, we want to break you guys up. I mean, look, I'm not a conspiracy theorist, but one of the conspiracy theories I have is that the FTC has a lot of like Microsoft cronies, and Microsoft is like secretly pulling strings behind in the background saying, yeah, let's get these guys. Because I mean, if you think about it, how is Microsoft allowed to buy Blizzard Activision, right? Which is a huge company.
Yeah.
But Facebook wasn't able to buy some indie like small game developer.
That's a hell of a point, bro. They spent $60 billion on Activision Blizzard, and Facebook could barely spend like $500 million on a small company.
Yeah, I mean, dude, to me it seems glaringly obvious, like that. Maybe one day Microsoft just woke up and said, "Look, the only way we're going to be able to, be quote unquote not be a monopoly, but at the same time be a monopoly is if we own these government people, right?"
Yeah,
so basically, they made an investment in these people very, very, very early on, and basically got them into their positions of power, and now they're basically pulling the strings in the background and hobbling their competitors. and doing whatever they need to. I mean, dude, Microsoft acquired Nuance, which is like
That's a $7 billion AI voice company. Yeah.
Yeah, it's like 80-90% market share in all of like diagnostic radiology, right? It's nuts how dominant Microsoft is in all aspects of like the enterprise. So it's just really, my thing is, why aren't y'all going after Microsoft? Because they control a shit ton of companies, shit ton of ecosystem, and whatever, it doesn't matter to me at this point. But yeah.
Okay, last question for you. I found out this yesterday. Microsoft asked their shareholders to vote on a resolution, and in the resolution, they talk about how MicroStrategy bought Bitcoin and outperformed their stock, even though their stock obviously has a lot more actual, like, real cash flows. If you were a Microsoft shareholder, would you vote yes to that proposition on them acquiring Bitcoin on the balance sheet?
Yeah, I think so. It's not a bad idea, man. I mean, you don't know what the total potential for Bitcoin is, but as far as I can see, there is no end limit, so it's a perfect hedge. I mean, yeah, I'd be okay.
Dude, I'd buy it in an instant. I would do a video a day on Twitter as Satya Nadella, and I would tell shareholders, I don't know if you're even allowed to, but I'll be like, vote for this shit. We spend billions of dollars on all this nonsense. We could buy $1 billion of Bitcoin and just let it chill. It's a no-brainer in my. They have so much cash. Even if they lose it, it's $1 billion. They have $80 billion in cash. Same thing with Apple. Apple has no growth. Imagine they put $1 billion into Bitcoin. I think it's a no-brainer.
Not to mention all the people who are going to be buying it because of Bitcoin proxyism, right? Like right now, if you think about if you look at MicroStrategy right now, MicroStrategy has a crap ton of premium to NAV that it's getting. Because what essentially you're seeing is like MSTR is just leveraging there's like this great video that people should really watch on how MicroStrategy is basically what they're doing is they buy Bitcoin. Because they bought Bitcoin, the stock is going up above their NAV. So they issue more shares using convertible debt, take that money, buy more Bitcoin, and then the price of Bitcoin goes up. So they use that to leverage up again. And it's just this.
It's the greatest Ponzi scheme ever. That's the point.
It feels like a Ponzi, but it's not necessarily a Ponzi. The only thing is the reason why maybe it's the collapse could be pretty catastrophic if things go like south too quickly. But I don't think that there's.
Well, now you got Larry Fink on your side. Things can go south, but will they go to zero? Probably not with Larry Fink, right?
No, because they're too invested. If powerful people are buying it, that means that you should probably buy it too. That's pretty glaringly obvious. Like watch the rich people. Whatever the rich people are buying, go buy that because that means that they see something that maybe other people are not seeing. So. This is so fucked up, but I feel bad for making fun of Carlos and Vitaly. They were like, "Oh, Bitcoin is going to 100,000," and now I'm turning around and be like, "No, I think Bitcoin is going to 100,000." I feel like a fucking idiot, I usually I'm the one that fights the cult, and I'm secretly I just came out and be like, "No, I'm a cult member too now," So.
Because dude, I was bearish on Bitcoin for a while as well, but it makes sense when you see the money printing, you see the debt, and you see the asset class in terms of how it can actually store value. I know people laugh at store value, but there is a legitimate argument for it. And then you see BlackRock get involved. BlackRock doesn't lose, bro. BlackRock doesn't fucking lose. And so
BlackRock just has too much control over things. Like you said, rich people buy it. Like when rich people buy shit, look, there's one goal of rich people, okay? Don't lose money. So if rich people are buying shit, that means that they're not trying to lose money. So they've done the research that you need to do to know that this thing has value. So I honestly used to think Michael Saylor was an idiot, but that guy's not an idiot, man. He's actually very brilliant, and let's see what happens. And I'm sure that there's going to be pullbacks, by the way. So don't in the comment section flame me and be like, look, he was saying Bitcoin's going to go 100,000. That shit went down to 30. Like, look, this. Hey, listen, there's a lot of things that can happen. Gold has taken multiple hits over the years. It's gone up and it's gone down, and then it's gone back up again. So the thing is, if you're looking at it just in terms of singular moves up and down, you're going to miss the whole idea. But if you're looking 5, 10, 15, 20 years into the future, you can see that there is some value in Bitcoin. It does suck that we couldn't buy this at a much, much earlier price. But I mean, dude, we've done well in the market, so it's whatever.
Yeah. All right, Chris, I appreciate it as always. Chris's Twitter right here in the chat. You guys can follow him there.
Oh, you didn't ask me about the cruise lines, bro.
Oh, I forgot, dude. Yeah, Royal Caribbean. So they had a decent earnings. How was that today?
Dude, it's doing good, man. I'm telling you, the cruise. A lot of people don't realize how much cash flow these cruise lines are throwing off, and how much value there really is. It's all being unlocked slowly, so people are kind of like missing the thing. And a lot of people still have the stigma when they look back at the COVID thing. So they're like, oh, I wouldn't touch a cruise line, or they'll be like, oh, look, the cruise lines have all these people on them. Like, I hate cruises, blah, blah. I'm like, look, you may hate cruises, but there's a lot of people that love going on cruises. And that shows. Like, these ships are fully booked out. Trying to get a decent room right now, like even a year out, is not easy. There's all sorts of destinations that people go on. These boomers, they freaking love going on cruises, and they're willing to spend money. The cruise lines right now have pricing power too, because there's not a lot of capacity that gets, like, this is not one of those things that has capacity that can be added instantly, right? There's a lot more, there's a huge moat around the business as well. Like, imagine a new cruise line trying to come in and competing against these other companies that have basically been developing a logistical footprint for the last freaking 60 years, you know? So I think cruise lines are like really, really worth looking at for a lot of people. I know sometimes people think like, oh, well, no, I missed the run up. And I'm like, nah, not really. There's still a good amount of upside left on both Norwegian, Carnival, and believe it or not, this newcomer. People are completely missing out. I mentioned in like my Patreon group, but Viking is also another one that is worth,
Viking Holdings, VIK.
Yeah, VIK. Look at it since its IPO. It's up 61% since IPO, and it didn't IPO that long ago. It IPO'd in May.
Oh wow. Okay.
Yeah, it's a $15 billion market cap. They've got a pretty good hold on like the river cruising market. So they primarily do river cruises, but they're more like luxury. They do cater to like an older, more affluent clientele, but there's a tremendous amount of value there that people have to like look at and use. I don't know if anyone in the comment section has been on a Viking cruise before. So if you want to comment on it, how did you like it? Was it something that you would do again? Look, me and you, one of these days, we need to go on a vacation on a cruise, all right? And just, I'm telling you, man, you'll see the value. Once you're on the cruise ship, you're on one of these giant cruises, and you're just chilling, and you're doing your market open from a cruise ship
Starlink
in the middle of the Caribbean with a Starlink. You'll be like, wow, this is amazing. This is like the perfect vacation, So, yeah.
All right. Appreciate it. Thank you, Chris. Chris's Twitter in the chat. I will talk to you again pretty soon.
Take care. Have a good one.
See ya. Bye. Derek, thank you again for another 50 gifted memberships. Again, it's at this point, the entire channel is going to become a member if Derek keeps this up. So where's SoFi right now? SoFi currently 1022. All right. So still it's struggling right there at that 1020 level. It did have a nice reversal to like 1050. Let's see if we can get back there. But if it can, maybe this dip wasn't a horrible dip at all to get into. So thank you again, Derek, for these 50 gifted memberships. It's funny. Chris was talking about see what rich people are buying. Derek is one of those people that I would classify as rich. And, one of the things he is buying is Bitcoin. And he's been part of this Bitcoin thesis since 2010. He's owned Bitcoin for a very long time. It is funny because every like high net worth person that I talk to, Bitcoin is a real part of their strategy. I mean, even David Tepper last week said that Bitcoin is something that he's long on along with gold because there's just no control to the money printing along with the debt that we're going to have to, in his words, inflate our way out of. So, there is an argument that a lot of rich people are figuring out how to consolidate into asset classes that can protect their money. And although ironically, people say Bitcoin is the worst store of value, I mean, for the past 15 years, it's been one of the best stores of value ever, like in the history of humanity. So it's one of those things that maybe you don't bet against it over the long term. I wish I could buy Bitcoin in an ISA. Yeah, I wish I could buy Bitcoin in my Roth IRA. Maybe they'll allow that eventually. At least we could buy the ETF to get exposure, but as of now, can't buy the actual Bitcoin itself. Derek says I'm all in on Bitcoin. He is pretty all in on Bitcoin. That SoFi screenshot I showed you guys, there was another screenshot a couple of weeks ago when Bitcoin was at 59,000. And that screenshot was a little bit bigger than this $500,000 spent on SoFi. It's so fun to be rich, dude. You could just fucking buy $500,000 of a stock if you're bored and shit. But like, yes, he is very, very concentrated into Bitcoin. And I mean, it looks like the cycle is happening. The other thing that he told me yesterday, which is also important, the calendar. So apparently yesterday was like literally 500 days after the something cycle from a couple years ago, which is what it happens every 4 years. And what do you know? Yesterday we bounce up all the way to 71,000. Right now, trying to make our way to 72,000. It's almost like clockwork the way these halving cycles and these event-based timelines work out for Bitcoin. I mean, it's kind of magical when you think about it when it happens. So if it's happening right now, maybe we see that run back above 73,000. JD Vance is going on Joe Rogan and they're filming it on Wednesday. Wow. Okay. That is big. Joe Rogan did say yesterday that he invited Kamala. Kamala's only argument to Joe Rogan was that he has to come visit her. And he said no. So he wants her to come visit. His stipulation was it needs to be 3 hours in Austin in his studio. Kamala said 1 hour in her studio. And he said no to that. So he tweeted yesterday that if they change their mindset, then he'll do the podcast with her. If not, then it looks like he's not going to do the podcast. Here's Larry Fink on interest rates. This came out yesterday. This is what he has to say about interest rates for the rest of the year.
Where the Fed finishes this year, would you expect a 25 basis point rate cut or a 50 basis point, or you don't know?
I think it's fair to say we're going to have at least a 25. But that being said, I do believe we have greater embedded inflation in the world than we've ever seen. We have government and policy that is much more inflationary, whether it's immigration, excuse me, our policies of onshoring, all of this, no one is asking the question at what cost. Right. Historically, we were, I would say, a more consumer-driven economy that the cheapest products were the best, the most a progressive way of politicking. Today, I think we have governmental policies that are embedded inflationary. And with that being said, I think we're not gonna see interest rates as low as some people are forecasting.
Okay, so he was struggling to get through that one, but basically he's saying, look, rates are probably not going to come down as quickly as you think they're going to come down. I still think we're getting another 2 cuts this year. The only way we don't get another 2 cuts is if we get a really strong reacceleration of inflation, which I don't think is happening. Have you looked at oil prices? I don't think shelter is going to be enough to push us over the edge, so I don't think that's the case. And if the job market explodes, but given this JOLTS number, I don't think we're going to get another 300,000 job month. We're going to probably get maybe 200,000, potentially lower than that. And if that's the case, the Fed has no reason to not cut. Labor market is slightly weakening. Inflation's coming down. You can't have monetary policy that's that restrictive. So I think we get 2 cuts. Also, the Fed doesn't want to surprise the markets. And if the markets feel that the Fed is acting in a certain way, the Fed usually tries to appease the market, not the stock market, but the broader Fed swaps when it comes to the futures on interest rate decisions. So if you look at it right here, you're looking at a 98% chance we get at least 1 cut, a 1% chance we are flat. When there's a 98%, 98.9% chance we get a cut, that means November 7th, we're probably getting a cut. For December, the probabilities are 73%. We stay 26%. 26% we're flat, 73% we get a cut, 0.5% we get 2 cuts. So even in December, the market's expecting a 70% chance we get another 25 bips, which means it seems very likely November we get those rate cuts, which is very good for Bitcoin. December, hopefully we get them. And if we get 2 more cuts, then that is not going to be a bad thing for the broader market. Definitely not going to be a bad thing for Bitcoin. All right, that's what we got going on right now. Where is SoFi? SoFi is 1025. All right, SoFi still down 8%. Little recovery from 977. Looks like 977 so far was the absolute bottom of the day. Hopefully that stays the case and we kind of make our way up. Look, 1025 is still not horrible given it was stuck at 7 for the past year. So I don't think anyone can be upset, but I think people are annoyed that this earnings was so good and it couldn't make a move higher. So now, here's the other bad part about this move, down 8%. The shorts get fuel from thinking that they can continue to manipulate the stock when it goes down 11% after a triple beat and a raise of guidance. And so shorts definitely probably feel pretty confident right now. Now, maybe that's misguided confidence. Definitely over the long term, that's misguided. But in the short term, if they want to double down on this, then at least today's one of those days where I think they will think they want to. DJT is now down 15%. It was up 15%. It got halted 3 times, and now it is up 1% on the day at $47. It was at $57 when the market opened. Why are the miners dropping? That's an interesting question. I don't know. That's a good point. Why is CleanSpark down? I don't know. I have no clue, to be honest. The miners, at this point, I don't think anyone can explain you can kind of explain MicroStrategy. You can kind of explain Coinbase. The miners, I feel like it's hard to explain anything about the miners. You would think that, you would think Bitcoin's up 6% in a day. You would think that it helps the miners. I don't know. And I don't think anyone can say, oh, the miners were front running this move, because at this point, the miners need an 80, 90K Bitcoin to remain profitable and have the margins they had from last year. So, I don't think it's front running. I think now it has to move in tandem with it, which hopefully what happened. Derek says short Palantir. Where's Palantir right now? 44.89. Yeah, let's just say Derek is not the most bullish on Palantir at this moment. He's way more bullish on Bitcoin than Palantir. But this is gonna make the chat hate him. You guys love Derek. Now that he said short Palantir, you guys are gonna hate him, right? Now he's gonna be like, you know what? We don't care about your gifted membership. We don't like you. You're short Palantir. But look, Q3 earnings is gonna mean everything. Q3 earnings, if we get that 30 to 35% growth, I think it'll be fun. Even though I know the valuation stretched. If we don't, it might look like Transmedics, which had a good quarter, but they were down 30% because the expectations were just too high. Here's the question. Are the expectations for Palantir too high? Because right now it's still 700 million. I'm not hearing that the street's expecting like $1 billion of revenue. If they are, we're going to tank because we're not giving $1 billion of revenue this quarter. If we do give $1 billion of revenue this quarter, we are going to, I don't even know what the number, if we put up $1 billion, that's probably not happening, right? So if we come in the middle at 750, I don't know how mad the street's going to get if they're not expecting $1 billion, So I think it's all based on expectations right now in the short term. Derek says, I'm here to make money. I love Palantir, but overpriced right now. Yeah, and that's fair. That opinion is shared by a lot of people right now in the market. That is fair. Hey, new to the stock market, what is the best stocks for long-term, and should I go for call options for the future? Okay, so Hunter, if you are new to the stock market, I would stay away from anything that has the word option in it. You got to take some time to just learn some of the basics. In terms of stocks for the future, I would start, first of all, with looking at what the index is, the S&P 500, taking a look at what are the major companies in that index, and then figuring out if you have the risk tolerance to invest in certain individual stocks, because it takes a whole level of new risk-taking when you're betting on Google versus betting on America, because Google is not America. The S&P 500 is America. If Google fails, America will not fail. But if your money's in Google and Google fails, then your money fails. So I would look into indices first, and then kind of think about what these individual stocks can look like as well. Derek said, dude, he's new to the stock market, and you're like, buy Bitcoin. This is what I love about Derek, dude. He's like, he's taken a lot of risks in his life. He's made a decent amount of money. He's also obviously preserved that money. That's how he's been able to stay rich, but he's still such a risk taker, bro. First thing he says to someone who learns about the stock market, IBIT, BlackRock. Look, it's probably going to outperform the S&P over the long term, but it's one of those things where you got to get into if you can tolerate the risk of these types of assets. Okay, let's get some due diligence on earnings that we have going on. What do we have right now? We have some news on PayPal and Pfizer. Let's take a little bit of an update on them, and then we'll keep going from there. Philip says, Amit is still scared of Bitcoin. I'm not scared of Bitcoin. I just don't have a significant amount of my net worth in Bitcoin because the volatility is up there, bro. Look, it's been a volatile year. A lot of my portfolio's in options this year. So it's been volatile. Bitcoin is just a different type of volatile. But I also think the IBIT ETF is a fun way to access Bitcoin because you just don't have to worry about the coin itself, but the ETF as a way to leverage it. And once they introduce options on it, then it's going to be fun because then you can wheel it. And I think that'll create a lot of more momentum in it. All right, let's get an update from CNBC, then we'll keep going from there.
Yields are putting a lid on equities for the most part as the 10-year gets to 4.32. NASDAQ is up 8 of 9 days, and we'll look forward to the first of some Mag 7 earnings tonight with Alphabet.
We are 30 minutes into the trading session. A lot of earnings movers today. Here's some of the ones that we were watching this hour. Shares of D.R. Horton are dropping. Earnings coming in well below estimates, saying interest rates are keeping buyers on the sidelines and forcing the company to give more incentives. F5 Networks, meantime, a top gainer on the S&P. At least 8 firms raising their price targets on this name this morning after strong numbers and an upbeat forecast there. JetBlue shares plunging. Earnings beat, but full-year revenue forecast missing estimates. And PayPal also dropping. Big beat on profit, but revenue falling short of estimates. The fintech also giving a weak revenue outlook. That stock is down 6.5%.
Getting some jolts and consumer confidence. Let's get to Rick Santelli. Morning, Rick.
Good morning, Carl. Indeed, JOLTS. This is September read. We're expecting a number somewhere in the...
Okay, we already got JOLTS. Let me move on from that. Let's get an update on Pfizer right here.
Pfizer needed this big beat and raise. But what's interesting is where this beat is coming from, and that's coming from its COVID portfolio. So in the quarter, Paxlovid, that's the COVID antiviral, that beat estimates by about $2 billion. And its COVID vaccine also coming about $400 million ahead of estimates. And remember, Pfizer is trying to move beyond the COVID franchise and get people to pay attention to what else is in the pipeline and in the portfolio. But the one area that it's focusing on a lot is cancer. And we saw some pretty mixed results there. A few of those drugs from Seagen coming in a little bit short. So we're going to want to hear more from Pfizer on the call about what is happening there in cancer. And, you know, JP Morgan today saying that Pfizer really needs to see more progress in the portfolio and in the pipeline to significantly change the narrative. And the big question, of course, today is, will this be enough to get Starboard off of Pfizer's back? And will this be enough for the company to get investors to buy into the story? And one area where Pfizer's trying to make progress is obesity. The company today saying that it expects an update on its experimental pill, danuglipron, early next year. It's also highlighting 2 other early stage pills in the pipeline. So again, we're going to want to hear more on the call today and see where those stand, guys.
Yeah, Pfizer beat by a lot this morning, and they did not really get the benefit from the market. Where's Pfizer at right now? Palantir 44.87, Pfizer down 1. Wow. Dude, they beat heavily on EPS and revenue. I guess that JP Morgan note about not knowing about their drug pipeline or the clarity around that is what's taking them down. Bitcoin still hovering, trying to get to 72,000. SoFi now down 9%. Royal Caribbean up 2%. Silver, have a small position in silver, but silver's up right now, up 2% right now. Moving with commodities. S&P goes green. Robinhood 27.98. IBIT $40.94. MicroStrategy $256. Alibaba 100. FXI China up about 0.12% here on the day as well. Where's the Mag 7? Let's take a look at them. Apple slightly red. Microsoft's up. Meta's up. Google, wow, 170. Looks like it's running into the earnings. That'll be today. I'll be live at like 3:45 today, and we'll get perspective on Google. Amazon 188, Nvidia 140, and you got Tesla right here at 261 right now on the day. Remember when Vitaly and Maddie were trying to convince him to buy Bitcoin? Yeah, dude. I mean, I didn't really get the Bitcoin thesis at 25,000, bro. I didn't get it. I'll admit it. I didn't fully understand it. You know when I really got sailored? I don't even call it orange pilled. I got sailored. I got sailored around February 2024. So like 7 months ago. I there was like a month where I watched probably 10 of his podcasts front to back. And that's when it finally like started to click a little bit more. And that's the, you know, whether you love him or hate him, he does have an ability to communicate his vision. And then it's up to you if you want to believe it or not. But it's a hell of an argument. It's a hell of an argument. And then when you look at his background, dude, Saylor's a smart mother effer. He bet on all of the big set of the Mag 7 in 2010 before they became the Mag 7. I think outside of Tesla, but he got the rest of them. And his actual business acumen is incredible. He like started buying domain names in the 90s because he saw the internet was taking off, and he was able to sell these domain names for hundreds of millions of dollars. Like, the guy is just a high IQ, smart individual. And Bitcoin made a lot of sense to him in 2020, and that's when he kind of went all in and took the bet. Amit, let's talk about Vlad at 10% of JetBlue, down 35 million today. Okay, so one of Derek's business partners that you guys know, he was on the channel with me as well. What's his name? Vlad on buying Palantir that day. He has a ton of JetBlue. I showed you guys those SEC filings of his ownership of JetBlue. JetBlue's down 14% right now. So he's probably taken a little bit of a hit, just a tiny bit of a hit in the portfolio. Now, granted, I think he's up overall on JetBlue. He owns a lot of shares. I think he owns like 20 million shares of JetBlue. But JetBlue's getting hit down about 14%. And what's interesting about JetBlue being down is United's up 80% for the year. Delta's up like 10%. Also, the oil prices are going down, which is really good for airlines. But for some reason, JetBlue said something on this earnings that has them down 14% right now. And again, that's the reason JetBlue is so cheap at like these prices, is because the street doesn't believe they're kind of going to turn around. I think at one point they were like $2 this year. They've turned around a little bit, but not enough. JetBlue CEO, I'm reading right now, said we are not interested in revisiting the Spirit Airlines acquisition. They said we would consider Spirit assets that may be sold. Where's Spirit Airlines as well? SAVE, Spirit Airlines. They are down 6% as well. Yeah, so this JetBlue Airlines was not bullish for a ton of different airline companies, and it's taken down the rest of the airlines with them right now. He owns 35 million shares? Okay. I thought he owned 20 million shares. That's a lot of freaking shares, bro. That means every dollar is $35 million. So yeah, JetBlue is basically down $1.06 right now. So that is down $35 million. That's a lot. That is a decent amount. How many Vlads do I know? I only know two. I know Vlad Tenev, CEO of Robinhood, and then Derek's business partner, Vlad, who also is like Derek, and he takes a lot of risks. Let's just say that. They take a lot of freaking risks on these assets. They're not selling those tickets any cheaper yet. Yeah, well, that's another thing. JetBlue is not that cheap, dude. I looked at their ticket prices the other day against United. I was like, why would anyone fly JetBlue? Like, they're not that cheap right now. Now, again, they're going to have to cut expenses and grow, and like they'll get the prices to eventually come down, but it's not like it was that incredibly cheap of a experience compared to other airlines. So there needs to be a broader differentiator. And again, airlines already are crappy businesses because they have no moat. There's barely any margin. So oil prices going down is a tailwind for them, but you've got to have like customer loyalty, which is why I'm so pissed off I don't own United, because I've been a very loyal customer to United for a decade and I never bought their stock. And their stock's up a lot this year. It's done pretty damn well. But in general, airlines are a tough business, so they're going to need to do some stuff to navigate that. Where's Archer? We were talking about Archer yesterday. I'm still doing my DD on this one. Archer, I know a lot of you guys like this one. Archer down about 3%, 328 right now. Archer's historical stock price, let's take a look at this. So it's down 67% all time, which is good because if I'm interested in investing, I want to get a discount. And this is a decent discount. Maybe I got to look at the financials, but at least from where it was trading at before, it topped out at 16 in 2021. Again, that's why everyone comparing 2024 to 2021, I feel like it is missing the boat. In 2021, if Archer could be worth $16, like that was a bubble. That is not what we're seeing right now. Not in 2024. So it's been hovering from $4 to $6 for the past 2 years, got to a low of $2 in May of 2023. So it's a little bit more expensive than where it was in 2023, but relatively the same. $1 billion market cap is another reason I'm getting interested in it. If it is the Uber of the skies and there is any argument that that industry takes off, at $1 billion market cap, you would imagine even at 3 billion a 2x, 5 billion a 5x, 10 billion a 10x, even if it takes time, these things could grow. And it's kind of what we saw with Oklo. Again, Oklo, I would not chase it here, but nuclear energy kind of just took off as the industry took off, and then boom, these headlines are taking these stocks to higher levels. And if they get more deals, they're going to solidify the multiple expansion they got. Maybe something like that could happen for the eVTOL space. Couch says, what about Joby? Yeah, see, I got to do DD on these guys. I don't know too much about the industry. Joby as well, down about 6%. Couch, I'm going to send you the link. If you can join the stream for like 10 minutes, you can talk SoFi and PayPal. I know you've got positions in that. Oh, I just saw your DM. Okay, perfect. Okay, I just sent you the link. So let's get Neil on the show, get his thoughts on PayPal and SoFi, and see what he has to say as well. Who is the SoFi of the sky? That's a good question. It's a very good question. Whatever SoFi of the sky is, I would hope they can fly and not crash like SoFi does after earnings, because that would be nice. SoFi 1007, goodness gracious, dude, is so annoying. Bitcoin's trying to make its way to 72,000, $9 away from 72 on Biddy. SoFi 7 cents away from below 10 as it's down 10% on the day. Everything else is still red. Palantir still holding up nice. 44.86 is not a bad showing on a red day. S&P now turning slightly green. Bitcoin again, 71.9. Oracle's up today. Spotify's up today. Apple just went green. Google, looks like people are getting excited for Google. Grindr's green. Airbnb 137. Oh, that podcast with what's his name, with Galley. He had a decent Airbnb thesis, dude. I suggest people watch it. I mean, it kind of made me feel more bullish on Airbnb. And here was the main reason for not forget all the numbers. Airbnb is a verb. Like in the next 10 years, do we think we're not going to say, oh, let's just get an Airbnb with your friends, and like one of the other points he brought up is one of the big, he's in his 30s now, and the most memorable experiences he's having in his life are with friends on vacation at an Airbnb. Not in a Hilton, not in a Marriott, but at an experience with an Airbnb. Now, that can't be the only thesis, but that is an argument that if, as a verb that Airbnb is becoming, encompassing the way it's being encompassed, hard to bet against it. Now, granted, the stock has sucked. The stock is like down 8% over the past 4 years because the investment bankers made way too much money off this thing and shareholders got screwed. But it is an argument, at least to think about when we go long for something like an Airbnb. All right, let's get Neil on the show. Neil, Mr. Couch Investor, what's up?
Hello. Well, could have been better, no? Could have been better.
Let's start off with SoFi, because SoFi is SoFi, and it's always SoFi. I mean, you thought it was a good quarter. I saw your tweets, but let's start off with that. What do you think about the quarter, and then what do you think about the price action?
I mean, very good quarter. Triple beat yet again, which begs the question, what happens when they start missing, right? Because triple beat, you're down 10%. What happens when you miss a double miss? It's down 50%. The company goes bankrupt, goes to zero. I don't know. But yeah, no, very, very good quarter. I mean, beat my expectations on various metrics. Maybe, I don't know, maybe the market still wants more information with regards to the tech platform, right? Because if you keep repeating you're the AWS of fintech, but you're not really showing us why or how you're going to be the AWS of fintech, then maybe the market wants to sit on the sidelines. Plus, okay, the stock has gone up quite a lot in the last couple of weeks. So it might be like one red day, and then it rebounds the next day. I think we've seen that 2 quarters ago with Robinhood, right? It dropped on great report, and the next day it's back up, and it went all the way to $20 or so. I don't know if it's going to happen again, but maybe. I don't see anything in the report. I haven't listened to the whole call yet, but I haven't seen anything in the report that says, oh, the business is not doing well. I mean, transitional year still growing 30%, not too bad.
Right. Top line business growing at 30% is pretty phenomenal. Why do you think the street? I mean, I know you said the stock was up a lot, maybe that, but this is a trend. After a triple beat, they take it down. It feels more like the banks don't believe in the growth story, even though they're seeing a growth story.
Yeah, and I mean, and remember, it was up 6-7% pre-market. Now we're down 10%. So the swing here is pretty aggressive. No, but overall, I mean, even I got here some numbers from Brett Freeman. I mean, even annual guidance updates, they raised and they beat across the board. So
yeah.
I honestly, I don't know. I know maybe 24 hours from now, it's back above $10 comfortably, and we're not speaking about this anymore. But to me, this, if you're not looking at the stock, you would think that this stock would have been up double digits, not down double digits after such a report.
Yeah, it is confusing. It's very
plus lending is coming back, so that helps. I mean, imagine interest rates come down, their lending business starts to become better and better, because that business has been completely destroyed in the last couple of years. So you're going to have lending back, plus the tech platform, financial services, all of them growing quite nicely. Company becoming more and more profitable, 4th quarter in a row, by the way. So yeah, I mean, I'm not complaining other than seeing the stock down. That's
what are you buying on this dip? Is it worth a buy, or what do you think?
Right now, no, I've cash, but since we're just starting the real earnings season, I rather wait and see what happens. I have placed a small bet on Alphabet yesterday.
Okay, let's talk about that before we get into PayPal. So what is your Google thesis?
I mean, I understand. Me personally, also, I use Gemini, I use Grok, I use a bit of everything. I've started to use Perplexity a bit more recently. It's pretty cool, pretty good. But my thesis is the cloud business is growing extremely quickly. It's becoming very profitable for them. Plus, with all the chatbots and everything, I still think they will be making a ton of money with search for years and years to come.
So you don't think Perplexity is going to take their lunch in a meaningful way enough to fuck up their earnings, essentially?
No, I mean, can they lose market share? Yes, they will be losing market share, just like NVIDIA in the future will be losing market share in data centers as well. That does not mean that they're going to be losing a ton of money. No, because in my opinion, the cloud will just become so big and so profitable that it might balance itself out and maybe even become a bigger positive. Plus, YouTube, in my opinion, I think in your opinion as well, YouTube still has a long, long way to go. YouTube also belongs to Alphabet. You get a bet on Waymo being successful, yes or no. If it's successful, that's another $100 billion business that they've got there. They've got DeepMind. They've got some great folks there. And who knows, maybe the next update, maybe you've seen the rumors that the next Gemini update, AI update can take control or can make some things on your PC. I mean, you write something and it goes and searches and books appointments and stuff like that. If it works out and it's not a flop like the last performance, then
it could be.
Then yeah,
it could push more growth. Yeah, no, I agree. Look, I'm bullish on Google. I'm a little afraid of today's results in terms of how Sundar handles the questions, but I do think at 21 times forward earnings, they're going to put up some decent numbers that make it so it should be closer to 25 times forward earnings, right? I think that would be a bit more reasonable. You guys on the screen right here, screenshot of Mr. Derek Wall buying more SoFi, so doubling down 60,000 shares on top of the 50,000 that he bought at 1025. Question for you here, Neil, outside of SoFi and Google, is PayPal. Now, these guys are down 7%. They lowered Q4 guidance, but they beat on the top and the bottom, or they slightly missed on revenue. Is it justified for them to be down 7% right now after they were up 4% last night?
I mean, I would have liked it if it goes up even more, but I guess, yeah, I mean, a small revenue miss for the quarter. For 2024, some things were raised and some things beat, so that's okay. Maybe it's because growth is not there yet, right? I think it's the slowest quarter ever since they became public, 6% or something, which is not great. But on the flip side, is it a struggling business? No. It's a business that's expected to generate $6 billion in free cash flow, 2024, buys back shares for $6 billion as well. So, yeah, I mean, me as a long-term shareholder, I did not see anything that's bad. Was it perfect? No. So, SoFi, triple beat, amazing quarter, stock is down 10%. PayPal, good quarter. Okay, maybe not perfect. The stock has also run up a little bit, but not by much. So yeah, I don't know. Maybe the market is still figuring out these fintech stocks, although Robinhood has been doing quite well. So yeah, I don't know. The market's very strange. Maybe if they reported yesterday, the markets are super happy, blah, 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 and the stock is up. Maybe today is just a weird day. I don't know. But overall, I still hold both of those. Am I buying today? No, like I said, I'm still waiting for more companies. Plus I have my Alphabet bet, which I hope it plays out.
Well, what, do you have a call option on Google or something?
No, I just bought shares.
Bought some shares today.
Bought some shares, yeah, and we'll see. I don't know. What did you think?
I'm just perplexed at a SoFi and PayPal's price reaction because like the earnings were good. I mean, like I feel like I'm getting better at analyzing an earnings report, and from my analyzing of these, like these were not reports that should take down SoFi 10% or PayPal down 8%, but I guess they ran up a little bit too much going into earnings, definitely for SoFi. And maybe the street has any little miss that they see and they just, get a little scared, which is fair because the market's at all-time highs right now, right? So you're going to get a little scared when it comes to this stuff. In general, I think PayPal's on a good trajectory. You've done a lot of work on PayPal. I think SoFi is going to be fine. But do you think there's any part to the fact that SoFi doesn't have the kind of zeitgeist of people's attention? I mean, for example, Robinhood doing this election betting thing, you can just see the innovation and the execution. SoFi just really doesn't have any of that. Is that part of a reason why the street's not giving them the multiple?
Yeah, I mean, it does have a pretty nice stadium, right? But yeah, the app, I've been saying this for, I can't use it, but every time my viewers say the same thing, probably yours as well, you've seen screenshots, you can see the app. It's not great, right? If you look at Robinhood, the experience is amazing. on SoFi, again, I go back to the same point. If you're saying you're the AWS of fintech, it shouldn't be such an issue to refresh your app, to make it a bit more modern, easier to use, and stuff like that. Now, do I think they'll offer contracts to bet on Donald Trump winning or Kamala Harris? Probably not. Probably not.
Right.
But okay, the basics of making a investing app look good and easier to use is not that difficult.
And sell
especially
covered
not.
calls. That would be nice, you know? Like,
Yeah,
those are basic things.
Yeah, exactly. But do I think that's why it's not up to date? I don't know. Probably not. Probably there's more. But I mean, there is, what was it, 15, 16% short interest. So that doesn't help. But
Agreed.
yeah, I agree that they could be doing better with regards to the app, for sure.
Bsoft says, thank you for the $5 super chat. This doesn't have to do with the analysis, but Neil, your voice is so calming. You could say, so Tesla's down 75% today. Wow. And I wouldn't panic. Can you try that? Can you say, so Tesla's down 75% today?
Yeah, so Tesla reported great earnings, but it's down 75% today, which...
that is very calming. I'm not going to lie. It's like, yeah, fuck it. It's down 75%. If it was me, I'd be like, guys, Tesla's down 75%. Like, it's a totally different dynamic.
Yeah, I mean, maybe from the inside it's different, but yeah, no.
What do you think about Tesla? The 270 to 258. Do you think that matters, or it's just, it had a big run, people take some profits?
Yeah, no, I think it's that. Plus, it's earnings season, so you can expect volatility. I've seen a comment from someone I've seen before, Blake, asking if I'm still bearish Tesla because of our live stream, and I said Tesla would go down after the earnings and not up. I'm not bearish. It's still my number one position.
You have to take Blake's comments with a grain of salt. This guy has been on my stream for the past 3 years saying like everyone is bearish Tesla if you don't say anything good about Tesla, if you're like kind of objective. So it's okay, Blake. We love you, but we're a little bit more objective.
Yeah, but I mean, look, the chart, it's still 260, right? We're still good. We're still good. And elections coming up next week. So I mean, it doesn't really matter what happens in this earnings season because volatility, the market will do what the market will do, right? You can have a triple beat, you can be down 10%, which send a message to all the other companies, right, that will report. A small miss will not be welcomed by my hug. I will be saying probably maybe this week, Apple reported earnings, they're down 25%. I don't think it will happen, but who knows, right? If they miss on iPhone sales in China.
But if it does, we need you to say it because that was very relaxing the way you just said it.
Yeah, if it does, maybe I can charge for it $5 per announcement.
Yeah, maybe we need you to say it. All right.
But you said something about Airbnb before.
Yeah. What's your thoughts on Airbnb? Do you have any thesis on this company?
I mean, I own it.
Oh, hold on. You own Airbnb? Okay, so give us the 2-minute pitch. Why should we be interested in Airbnb?
Why do I own it? One, it's a free cash flow machine. That's one. Two, like you said, it's a verb, right? We Airbnb. You've got cool locations. You can travel with your friends. Cool experiences. You get to go to places and not just be forcing yourself to be. Oh, I have to go to a hotel now. I have to be in a city. No, you actually can go to places around the world and experience the stuff there because you have access to a bed, a living room, whatever you want to choose, in the weirdest places, but very, very nice. I mean, I love to go on Airbnb and just check out the weirdest places there, and there are some places that, okay, cleaning fees is an issue. I agree. To hell with the cleaning fees. But you cannot tell me that traveling through Airbnb and experiencing countries, cities, whatnot, in the wild, in some weird house, is not better than just staying in the city, in the same hotel every single time. Plus, it's a very, very tech-focused type of company. So their app is very, very nice, very easy to use.
Yeah.
They're adding new stuff every year. Plus, the CEO is saying that they plan on launching new products that each product should generate $1 billion in revenue. I don't know what that could be. I mean, they could do a lot of things in travel.
Are you concerned about the user experience of people, about the cleaning fees, and like sometimes there's cameras in the Airbnb? Like, how do you think about that perspective?
Yes, but remember, it's always the negative reviews that get a lot of noise, right? I'm sure I can show you a ton of articles where you go into a hotel and you have blood stains on the wall and some other stuff there. So it's not like hotels are always 100% clean and there are no issues there. But yeah, the cleaning fees, I don't know. I've seen some folks paying so much money, like more than the stay. It doesn't make any sense. Doesn't make any sense. So maybe, I don't know, Airbnb can acquire a cleaning service, or they pay for it, and in the future probably going to be robots that clean your room. But I think we're still far away from that. But yeah, again, negative reviews always get amplified.
Yeah.
My first client.
Yeah, I think it's fair. I'm not long the stock yet, but it's definitely got me interested. I did like Ghali's argument, which is your argument that free cash flow is turning into
It's
a monster.
crazy.
It's insane. And maybe the street doesn't love the top line growth at 11%, which is fair, but free cash flow is a way better metric than top line growth for a business like them. And it's a tech company, so the margins are good. So, there is an argument there. I guess the broader thesis is over the next couple of years, do people legitimately not want to go to Marriott's and Hilton's and go to Airbnbs? And we've already seen that with the Olympics. I think that 120 million bookings or something in 1 month in Paris. So if that trend continues, it's hard to imagine the street doesn't recognize that value over the long term.
I mean, I can understand going to a hotel, but it's different type of traveling. If you're alone, then yes, maybe Airbnb does not make much sense. If you are with a family or friends, why not? Instead of taking a couple of rooms, you just take a whole place. It just makes sense. And yeah, maybe you could say, what if we enter a recession, consumer spending goes down, then yeah, maybe travel does not boom next year. Could be, but for now, I think yesterday was Royal Caribbean that reported. They didn't say anything bad, so for 2025. So I think people will still travel. Plus, you can still work from home, from anywhere, a lot of the time. So even if there is a dip, and maybe there will be a dip in the stock, I think it could be a good one to pick up for the long run. But then again, a lot of things can change. But yeah, Airbnb, I think 10 years from now, we're still going to hear about Airbnb. This is my opinion.
Okay, last question for you, rapid fire. Here are the companies reporting after the bell on Tuesday. Just give me a bearish or bullish post their earnings, what you think the sentiment will be. Google.
Beat.
Visa.
Visa, I would say beat. Maybe miss on the revenue, beat on EPS.
AMD.
AMD, I have Intel, so whatever they say, I get hit or not. AMD, I think same thing, revenue miss, EPS beat, but the focus will be on if they raise their AI revenue guidance again. I think it's now at 4.5 billion or something. Maybe if they say 5 billion, then it's fine.
Yeah, I agree. And Novix?
And if not, who's that?
You don't know Novix? Okay, it's a battery company, ENVX.
No.
This one's big on Twitter. Okay, ENVX. Okay.
Okay. I've seen this one. I think from Vitali or some other folks. Yeah, the batteries.
Yeah. Yes. Okay, so let's do the last two. Chipotle.
I would say, I think a miss. I think a small miss. I'm just saying this because of the McDonald's stuff.
Yeah. All right, and last one, everyone's favorite, Snapchat.
Snapchat. And of course, they have to report before, when not that it matter much. Snapchat, probably the same as always, right? Goes down. I don't know. If for some reason it's up, then Meta will go up as well. So, okay, fine.
It's already down like 40% from the last earnings. So I feel like this is when it gaps up and the cycle continues next earnings where it falls 40%, but maybe it falls 40% again this earnings, go to $7. So,
I mean, I have a feeling it's been at 1080 for so long.
Yeah, I agree. All right, that's it. Neil, thank you for joining. Appreciate it. I'll put Neil's YouTube and Twitter in the description, but it's in the chat as well. And yeah, I'll see you on the next one.
Yes, sir.
All right.
Bye-bye.
Thank you, man. Bye. All right, folks. I think that is it for today. Yeah, kind of a wishy-washy experience in the market. 580 on the S&P, Palantir 4481, basically flat. SoFi, the one that kind of pissed off everyone this morning. And it's not SoFi's fault, in my opinion. I mean, it's the broader market and their relationship with SoFi. But this one down about 9.4%, and that one kind of taking the headlines away. PayPal as well down 5.35%. JetBlue down 14%. United actually just went green. Bitcoin trying to make its way to 72,000, which would be incredible today. That JOLTS number kind of shows that there should be a chance for more rate cuts, which would be good. You got Robinhood at 27.93. And then you got the S&P 500 going slightly green right here at 581. That's what we got. All right, so I'll be back at 3:45. We've got Google, AMD, Snapchat, Visa, Enovix. It's going to be a very long night. Make sure you have some food. Make sure you have some time. We're going to be live for probably 2.5 hours. We'll be listening to Google, but we'll be tracking all these other companies. And we're going to have a lot to discuss and a lot to go through when it comes to the first official day of big tech earnings, which starts today. Word of the day. What is the word of the day? It is abracus. Sounds very weird. Abracus? Abraxas? Abraxas?
Abraxas.
Okay, abraxas. That first one, forget I even had that first pronunciation. A word of unknown significance found on charms, especially amulets of the late Greco-Roman world. Ancient magicians and healers often incorporated the word abracus into their spells and rituals to invoke supernatural forces. Scholars have long debated the meaning of abraxas, which appears frequently on charms and talismans from the Greco-Roman period. I don't know what the hell this is, dude. This is a random ass word. Let's get a different word, bro. Word of the day. Let's go to Merriam-Webster. Let's get something different. I have no idea what to even do with that word, abracus. Word of the day is omniscient. Omniscient.
Omniscient.
Okay, I actually know this one. This describes someone or something with unlimited knowledge or understanding. This one's a better one. Omniscient. So I guess today we're going to see if I am omniscient about Google. I'm sticking with bullish Google. I feel like I'm going to be wrong about this now. The more I hear these analysts on CNBC about how like Google's dead, but like I said, Google's bullish on Monday. I'm going to use my omniscience around Google for today to hopefully say I'm right. And if I'm wrong, then I'm wrong. But we will see. Oh, I love this one. Kiss my abracus. I love that, Julie. That's a good one. That's a good one. Kiss my abracus. I love it. Sailor is omniscient. Correct. Yeah. Forget Google. Sailor around Bitcoin is omniscient. Oh, is SoFi on CNBC? Do we have Noto? Let me see if I can get him. He's not on yet. They're in commercial break. Is he coming after commercial break? I would love to end on that. We could listen to Noto. And we could at least see some of his thoughts that he has to say. He's not there yet. Maybe he'll be on in like 2 minutes. I think we wait until watch that. I think we should wait until watching that. Yeah, I think he'll be on. Let's wait like a minute. Let's wait a minute and let's see if we can get it. Derek says, pump my bag. So Derek, now you have 110,000 shares of SoFi, 50 plus 60. Yeah, 110,000 shares of SoFi. I was telling you guys in the chat, when Derek gets conviction around something, he gets conviction and he just buys a shit ton of it. So for all the SoFi shareholders, you should be very happy that Derek decided to jump on the train today because now he's in it. But if it doesn't go up soon, he'll cut it. He won't give a fuck, dude. He'll be out of this shit. So you've got like a week to impress him. And if not, he's out and he's moving on. Okay, I think Noto will be on in like 30 seconds. Starting after the break. Okay, perfect. Perfect. Then we'll see. Cool. So he'll be on very soon. What price is he at? I think he's in $10. He's in to SoFi. This is the good thing about having YouTube TV. We can get these things live when they're happening. Chris says Chris Patel is omniscient. Look, Chris has had some omniscient picks. That is correct. That is indeed correct. Where's Bitcoin right now? Bitcoin 71.8. SoFi right before Noto goes live is at 10:21. All right, so he should be live in like a minute. And when he's live, let's see what he can say. Now, look, here's the thing. Here's what I'm curious about. Will they ask him about the tech platform? Because last time they asked and he kind of shrugged it off because he just didn't really have enough to say here. Kind of the same feeling we had in the earnings call. If he can actually say something a little bit interesting, a little bit exciting about, the tech platform that's different, maybe that can help the stock. But overall, it was a good quarter. It shouldn't be a hard interview to get done or a hard interview to say anything. All right, let's see.
Watching shares of SoFi today, the stock is taking a hit despite the company beating estimates, raising its outlook across the board for Q3. Joining us this morning is SoFi's CEO, Anthony Noto. Anthony, great to have you. We mentioned the price action, although we should also point out stock's been on a bit of a tear lately. Can you talk about what the quarter brought?
Sure. Thank you, Carl, and thanks for having me on. This was the strongest quarter in our company's history since I joined in 2018. We saw an acceleration in our revenue growth to 30% year-over-year growth. Importantly, we're not just a lender anymore. We saw 64% year-over-year growth in our financial services and technology platform revenue. Those are high margin revenue streams, high ROE and capital light. And so we continue to diversify the business. We've been able to overcome a really tumultuous environment over the last 5 years, both in terms of rates, in terms of the pandemic, in terms of student loan refinancing, to deliver 17 quarters of record revenue. And this made it number 17. In addition to that, really strong profitability. And so the breadth of the business is driving durability of growth, and we're improving shareholder returns. At the same time, meeting the needs of more members. Our members and products grew 35% year over year. We're really excited about 2025. It will mark I think the best environment we've operated in since I joined 7 years ago, with rates declining in a stable economy.
Yeah, we're hoping on the rate decline part. A couple of days ago, the news was about this loan platform agreement with Fortress. Can you talk about what that'll contribute to 25?
Yes, the loan platform business is something that we started back in 2019. Initially, we would generate demand for loans that we would otherwise decline, and we passed those on to partners, and they would provide a loan, and we would get paid a referral fee. And then the next phase of that business was we integrated someone's credit model into our decision engine. And when we couldn't approve a loan, we ran that application through their decision engine, and we got paid a fee for that as well. Now we're actually getting contracts with partners that want us to produce loans on their behalf. They're loans we wouldn't otherwise produce, and we get paid a fee for that as well. And so this was a big quarter from that contribution item. Again, it's high ROE, high margin, and low capital intensity. And there's an increasingly a lot of demand for that product. We declined about 80% of the applicants for personal loans at SoFi. And so we have a lot of resources that we could generally monetize. And this is a way for us to do that. So it's a low capital, high margin, high ROE way to do so. And it doesn't really come at an additional cost, because there are people we'd be turning down otherwise, or volume we wouldn't have otherwise underwritten because it was above our risk tolerance or where we want our balance sheet to be.
Low capital is really the hallmark, the foundation for the transition. You've talked about 2024 being a transitional year and 2025 being the year in which you got the wind at your back, so to speak, with a lot of things going right for the business. When it comes to the nuances of the 2024 guidance raised, though, Anthony, a lot of that was driven by lending, which is not the low capital part of the business, and technology. That guidance on the platform came down for a second consecutive quarter. Can you talk to us about where you see that trajectory going as you go into that 2025 year that so many people had so much expectations for?
Sure. So the lending business grew 14% year over year in the quarter, which was a little bit above expectations. The thing that outperformed was the loan platform business, which is in our financial services sector. We also saw an acceleration in growth in the technology platform. So if you combine the technology platform revenue with the financial services segment platform revenue, that totaled about $238 million in the financial services piece and over $100 million on the technology piece. Combined, that grew 64% year over year, which is what drove the acceleration of 30%, because lending only grew 14%. We've increased our outlook for the year because of strength across the entire business. We lowered the bottom ends of the tech platform revenue range, primarily because our partners and potential partners have been slow to make decisions, given the uncertainty with the election, the uncertainty with the economy next year, and they're delaying decisions. And we just wanted to be somewhat more cautious in that area. We're very encouraged about the demand that we see for new technology services. It's just taking longer for those deals to be decided. It's not that we're losing the deals, it's just they're not been decided, and we think we'll win our fair share.
The other thing I'd say is that we're seeing really strong demand in consumer deposits, which gives us confidence on the growth of our SoFi Money business. And our SoFi Invest business is also seeing really strong trends. That's what's driving the 37% year-over-year growth in our products, which we added more than 1 million new products in the quarter.
How should we look at those delayed deals, Anthony? Are these just deals that are deferred, or do the deals change in terms of quantity, in terms of size, based on who wins the election?
Yeah, I think the deals are just deferred. The reason why the deals are just deferred is because the technology upgrades have to happen. Large financial institutions have 3 inherent issues with their technology. First, it's out of date and it's not allowing them to innovate the way they need to. Second, it provides a lack of real-time asset and liability management. And third, there are regulatory reasons for them to have to upgrade their technology. And so it's a matter of when, not if they do so. Now, they could choose other partners besides our technology platform, but we believe we're best of breed. It's what's powering SoFi. It's what we're investing in for SoFi, and we think would serve their needs as well. We've made a conscious decision to actually accelerate our transition to a new technology platform so that we can be sure that as we implement that technology at SoFi, we can do it in an equal and as confident way as for our partners. The other thing I'd say is the election isn't so much about whether or not they should be spending the money. It's a question of what the pace is and what changes could be in the future based on capital scenarios from the different administrations.
Finally, Anthony, I know it's always a bit of a loaded question, but some of the analysts did point out, given the tailwinds and some of the stability in consumer and the stock, does a capital raise make sense in the medium term?
No, we're fully capitalized. Our capital ratios we talked on the call are well above their limits and where we have to be from a regulatory standpoint. It really just depends on how fast we want to grow. Right now, we like growing 20 to 25% revenue year-over-year growth. We obviously grew faster than that this quarter, 30%, but we need to be very prudent on our balance sheet and not grow too fast. We've limited what we'll put on the balance sheet. That's why the loan platform business is so attractive to us. It allows us to grow faster than we otherwise would if we didn't have that business, but not necessarily adding assets to our balance sheet. So, we feel really good about being a steady, consistent 20 to 25% grower, not try to push the growth too far because it'll take on more risk, and be very prudent. We have to build trust with our members and make sure that we're there for all their financial services needs. And so we don't want to grow too fast and outstrip that capability.
It's always helpful to have you shine a light on the quarter, Anthony. This one's no exception. Thanks as always. Good to see you.
Thank you as well.
Anthony Noto.
Look, that was a good segment. That was not a bad segment. He answered everything the way he needed to answer. He had the excitement. He had energy. He explained their growth. He explained on the tech platform question, again, the same thing he said on the earnings call. We're trying to win some deals. And so it's the kind of the same thing he said. It was nothing too different, which was fine. Bitcoin right here at 72,000. Stock on SoFi 1033 went from 1020 to 1033 off that interview. So you got about a 13-cent bump. Still down 7% on the day, but I don't have any issues with that segment. I thought he was good for 6 minutes and talked and explained what he needed to explain about the quarter. So decent segment. Again, the street seems to be concerned about something deeper around SoFi, which is why it's down 7%. But it also could just be people taking profits. Bitcoin right here is above 72. Now it's 72.1. So it's actually trying to really break through 72. MicroStrategy, 256. Coinbase, 219. CleanSpark, 1253, and then BitX, 7%. So BitX is one of the only proxies that's really moving this morning. The other ones are kind of flat, and that's because they kind of moved yesterday, so they kind of front ran it. Robinhood is 2808, up about 0.72%. So Bitcoin 72,000. It's very volatile right here, but if 72,000 is starting to, at least the 70s are starting to normalize for Bitcoin, then maybe it has a chance to get to all-time highs. All-time highs is at 73. We're at 72, so looks like there is a shot where it might be able to get there. It's a short attack on SoFi. Yeah, that could be another thing. It could be a short attack on SoFi, and eventually the shorts get bored of it or they move on. So that could be another reason why SoFi is getting hit down about 7% right here. All right, cool. That's it for me. Bitcoin 72K. I will see you guys at 3:45 p.m. We will keep going from there. We got Google after the bell. Where's Palantir? Palantir, look at that, 44.94. We did hit 45 a couple minutes ago. Pretty incredible, dude. Market's kind of reddish on the day. We're starting to get green. SoFi's also starting to recover a little bit at 1035. Palantir just 5 cents away from that $45 range. Robinhood at 2809. Palantir 44.95, and the S&P 500 right here is at 581, up about 0.03% on the day. After the bell, we've got Google, Visa, AMD, Snapchat, Chipotle, tons of companies, tons to get into. 3:45 p.m. I will be here. Derek, thank you again for all the memberships. Really appreciate it. I think 100 people today got memberships, which is just awesome. So thank you, Derek. Thank you, everybody, for being here. See you guys 3:45 on Market Close. Bye, everyone.